Good afternoon, everybody, and thank you for being here with us today. I'm Yannicka Radcliffe, and I'm the Vice President of the Housing Finance Policy Center and the Metropolitan Housing and Communities Policy Center. And I want to welcome you all, both in person and to the virtual audience, to the Urban Institute for a very timely and important discussion on the progress that has been made in incorporating alternative data. By that we mean particularly rental payment history, but other sources of alternative data as well, into credit scoring and mortgage underwriting. Over the years, Urban Institute research has demonstrated through evidence-based data-driven analysis how home ownership could be more attainable, particularly for borrowers of color, if mortgage underwriting included additional features and factors like rent reporting and cash flow data as predictors of mortgage performance. Using alternative data in mortgage underwriting, can expand access to loans for borrowers with missing or thin credit files, lower mortgage costs for borrowers with low credit scores, and likely benefit Black and Latino borrowers, especially in helping to close the historic and persistent racial homeownership gaps in America. But as we all know all too well, changing the mortgage underwriting process is not easy. So we're really excited about alternative data where there's so much growing evidence and innovation and promise. This is one of our favorite topics here at HFPC, and we're excited to showcase some of the latest insights and innovations in this rapidly evolving space. I'm clearly not the only one who thinks so, as we have a full house here today and over 800 people registered to watch online. I want to especially thank Built Rewards, who's a Housing Finance Innovation Forum member with the Housing Finance Policy Center, for their thought leadership and for their support for this event today. Thank you, Jonathan Lawless. And a huge thanks to all the subject matter experts and innovators who are contributing to today's program, which will cover, among other things, new findings on the impact of rent reporting on credit scores. What changes can enhance the effective use of alternative data in the mortgage industry? Recent innovations that can help consumers build credit beyond traditional methods, and policy considerations for use of alternative data in mortgage underwriting. But first, I have to cover a few housekeeping items for both in-person and virtual attendees. Today's event is being recorded, and the recording will be posted online at urban.org afterwards. Closed captioning is available. You have to enable that on your screen. The speaker biographies and slides are available online at urban.org. And the virtual audience can type in questions in the Q&A form linked in the Zoom chat. In-person attendees can use the QR code on your tables. And I believe online, there will be a QR code as well for your use that we will post intermittently throughout the program, so you can use that link. And then please engage with us online using the hashtag #LiveAtUrban. And lastly, after the event, please do take a moment. We'd love to hear from you, fill out the survey. Your feedback helps us continue to improve on our events. So with that, I would like to introduce my colleague, Jung Choi, a Principal Research Associate with the Housing Finance Policy Center, who will kick off our program discussing a data presentation covering the potential of alternative data. Thank you so much.
Okay, good afternoon, everyone. Thanks for joining us today in person on a very cold, windy day. And also thanks for everybody who is joining online. So I'm delighted to be here to provide a brief overview of today's topic, the potential of alternative data in credit scoring and mortgage underwriting. So let's quickly start with a quick definition. Alternative data, what is it? So alternative data refers to information currently unreported or underreported in the 3 national credit bureaus, Experian, Equifax, and TransUnion, that is used in generating credit scores. So while this data can be many things, today, as Yannicka mentioned, we will mostly focus on rent payment data, which is a very promising data in both credit scoring and mortgage underwriting. So why alternative data? As many of you know, today, there has been a numerous discussion on the potential of alternative data. For example, past studies show that cash flow data complements credit scores, and using both improve the predictability of credit defaults. One of our research also shows that past housing payment is a stronger predictor of future mortgage default compared to FICO scores. Thanks to credit advancement, reporting rent payment and to credit bureaus and also accessing bank account data has become easier and more cost effective. So we are finally seeing some innovation in this space, which will be the focus of today's panels. So how can alternative data be used in mortgage underwriting? So there are largely two methods of incorporating alternative data into mortgage underwriting. First is to use this data to improve the existing variables used in mortgage underwriting. For example, including rental payment in credit scoring. The second way is to examine alternative data separately in mortgage underwriting to complement existing variables. So we access the bank account data directly during the mortgage underwriting process to look into the cash flow information. And both are now being explored and implemented. So what are the recent innovations? So there has been more and more efforts first to facilitate rent reporting and also using the credit scores that incorporate rent payment in mortgage underwriting. For example, in 2021 and 2022, Fannie Mae and Freddie Mac has launched programs to incentivize multifamily owners to report tenants' positive rental histories. And second, several fintech companies, including Built Rewards, have made it easier for tenants to report rent to credit bureaus. Additionally, a few nonprofit organizations, for example, Washington Housing Conservancy, who we will also hear today, have enabled residents to report rent payment to credit scores. And the most updated FICO score and Vantage scores does incorporate rental payment into the scoring models, and it's in the process of being used in the mortgage underwriting. So this is the focus of the first panel of today. And then there's also been some efforts to include, examine bank account data directly in mortgage underwriting. For example, in 2021 and 2022, both Fannie and Freddie started to allow evaluation of on-time rental payment history in their desktop underwriting for applicants who fail to meet traditional credit standards. In 2022, FHA also updated its underwriting protocols to include positive rental history in their total scorecard. Several fintech companies, including Form Free and Plaid, who also we have on the panel today, have improved utilizing bank account data through advanced technology. So this would be the focus of our last panel of today. So as Yannicka mentioned, there are a lot of potential benefits of including rental payment into credit scoring and mortgage underwriting. Credit history, as you know, is one of the most frequently mentioned reasons for mortgage denial. By including alternative data, we could improve the risk measurements of many borrowers, especially for those with no or low credit scores. This could expand mortgage access to and also lower the cost for mortgages for some population in this country. As Yannicka mentioned, this change could have a particular benefit to a lot of people of color because they are less likely to have FICO scores and are more likely to have lower FICO scores. For example, in 2018 FICO score data, we find that 30% of Black consumers didn't have a FICO score and 34% of them had FICO score less than 620. For the Latino consumers, we find that about 27% didn't have a FICO score and 23% had FICO scores below 620. So by including rental payment history, we can make huge progress in expanding the access to homeownership among communities who have really faced challenges in accessing homeownership throughout our history. So although we have made some progress in this space, there are still ongoing barriers. First is related to data collection. So currently, less than 5% of rental history data is in the credit files. So even if we use the most updated FICO or Vantage scores, we still don't really have fully incorporated the rent data is also challenging. And there are several reasons behind this difficulty of data collection, one being a lack of consumer awareness. So one of our research finds that about 45% of consumers are unsure whether their rent is reported, and many who say their rent is reported are actually likely to be misinformed. We also find that many consumers don't really realize the potential benefit of rent reporting, which also needs some work on. Data standardization is also needed to have a scalable impact. Many of the lenders that we talked to said that it'll be really helpful if the GSCs could provide a more clear guidelines on how to use this data and also on the data standardization. Finally, we also need clear regulatory guidelines to ensure responsible use of consumer information. So here are the 3 topics that we will cover today. So we will invite many experts in this field to go over these 3 themes. So the first panel will be focusing on how rent reporting impacts credit scores based on new research and evidence. And in the second panel, we will invite some innovators who have developed new solutions to help consumers build credit. And in the third panel, we will focus on ways to improve direct usage of alternative data in mortgage underwriting. So with that, let's welcome our first panelist to the stage. So welcome everybody to the stage. So I'm gonna, so in the first panel, we have 4 experts. I'm gonna introduce from the left side. So we have Brett Theodorus from the Urban Institute, and we have Jonathan Lawless from Built Rewards, Yvette Rose Kane from the Washington Housing Conservancy, and Ethan Dornhelm from FICO. So all the bios, as Ionica explained, if you look at the agenda, there's a QR code. So if you hit the QR code, you will be access to their bio. So I won't go over them in detail, though I can spend like maybe half of this time going over the bios and like sharing all their brilliant work. But we just because of the sake of time, we will jump straight into the topic. So first, we will hear from Brett on the newest findings on the relationship between rent reporting and credit scores. So Brett.
Awesome, thanks. Great to be with everyone. Thanks for those who made it in person, and thanks for joining online. This is joint work that I will be presenting, Dan and Sam. Thanks also to Credit Builders Alliance, who helped with implementation in the field and research funding from NEFI. Okay, I'm gonna give you, is that all right?
Everyone's gonna go.
Okay.
Yeah.
Sorry if you're online and
do
not
not disturb.
Experiencing the fun in the room of 100 Amber Alerts going off at once. Okay, so we set out to do a study to look at the impact of rent reporting on tenants, in particular looking at credit scores, looking at credit access, looking at debt levels and utilization and loan performance. We didn't really frame this as a mortgage access study, given how we position the study, but it still will have some information to share there. So the way that we designed this study, it was a randomized controlled trial. So that means some people got the thing and some people didn't get the thing. It wasn't a complete yes, no, though. It was a get it now and wait, and then you get it in 5 months. So everybody was entitled to get the rent reporting. It's just some got it right away and some had to wait. You're right. In terms of how we set it up. We were working with residents in affordable housing. And so that include mission-based groups. The renters did not pay for the rent reporting, and it was an opt-in process. Okay, I know you're all eager for the results, which I'm going to walk through on this slide. But the bottom line is that we find an effect, and that effect is present in terms of having a Vantage score. What you see on the far right is that's the treatment on the treated, TOT, estimate in terms of the effect of an increase in having a score. You can see this initial treatment and control group. We looked at the average change in a score. We do not pick up an effect there. We do pick up an effect when we zero in on people who started at a lower score range. So those who are below 600, we see this effect that's present pretty robustly. We don't pick up an effect for people who started, for example, above 660. We did some sensitivity to that. It's definitely the effects there at 580, 600, maybe 620. It's not there by the time we're looking at folks who are already 640. And since there's up to 24 back months of reporting by month 1, when they sign up and get their rent reported, that means waiting only 4 months, 5 months for the initial treatment is fully adequate because the effect should come pretty quick. So I'm going to show you how this looks visually, just with kind of the size of the bars being the proportions of the group. So this is our control group that didn't get rent reporting at the beginning and then looking 5 months later. So the share that is unscored, basically the same. A couple people moving into the subprime or the near prime or better groups. And then about an even amount of folks who are moving from under 600 to over 600, from the yellow to the blue and the blue to the yellow. That makes sense. So let's look at what happened to the treatment group. Those are the people who got their rent reported. You can see we started with about the same number of unscored, but about half of those who were unscored are getting scored. So there's a much bigger movement into getting scored. Some of them into the under 600, but actually a good amount of them into the over 600 group. And then looking at the next segment, the yellow there, of those with scores under 600, there is a movement as well to the over 600. Now, of course, as before, there's a movement from over 6 to under 6, but that is a smaller share than is moving over 6. So that is what I wanted to set up in terms of initial results. We've got a lot more detail. The full report should be out soon. A really intriguing effect on balances that we're going to be digging more into, and future work should as well. And we're also able to talk a little bit about the real world work of implementing rent reporting and lessons learned along that way. But I'm going to pause.
Yeah, thank you, Brett. I think this is really interesting to see some variations in the impact of rent reporting across different groups of the population. I was also wondering whether any of the results surprised you, and also during your study, did you also observe any challenges in rent reporting itself among the populations that you studied?
When we presented these results to our partners, they were not surprised. They weren't surprised that the benefit is most present for people who have lower scores or who are unscored. So that seems to comport. I would say, I think it's important that we not conflate being low income with having a low score. There are plenty of people in assisted housing where the 6 providers were working that we studied that are not necessarily low scored. And that can depend if we're talking about a senior building or different types of properties. There's some diversity there. But it is to say we shouldn't immediately map on some of the other factors that are going on to credit. The reality of getting rent reporting up and running was a challenge. It took a long time. It took the housing providers a lot of work, and we tried at it a lot of ways. It needed to be opt-in for human subjects reasons and also what the providers themselves wanted. And we tried through property management, we tried through resident services. There's a high bar. And so that said, for folks who are interested, it still was a challenge. And it was a challenge because a good amount of the time, actually a quarter of people who enrolled in our study didn't actually, because maybe their name wasn't on the lease. Maybe it was the boyfriend or the girlfriend or the son or whomever that might have been on the lease. Even maybe the property manager may have had a different understanding of that. So that's a challenge. And then we take another segment. Here we go. I'm going to show it to you. That already had a 600 plus score. And then we had a share that just didn't actually have their rent reported in the end. Maybe they moved. Some people passed away. Some people didn't pay their rent on time. And this was opt-in, positive only. And so we get to the segment that really can benefit from this, and it's that segment at the bottom end. So that's not dismissing the benefit. It's just saying, how do we target it to the people who are really well positioned to benefit from it?
Thank you. I have actually tons of more questions, but then we'll just move on and we'll probably have more questions and Q&A sessions at the end. So now we will move on to Jonathan Lawless from Built Rewards, who will be sharing some of the work done by Built and also some of the data that he sees from Built related to rent reporting and credit score.
Awesome. Let's see if this one works. All right, perfect. Thank you to the Urban Institute, John, and everybody on the panel, everyone that's here. I think this is a really important topic, and I'm glad that we're having this discussion today. A little bit about my background. I spent some time, my first career was in analytics, and I led the team that built underwriting models at Fannie Mae. And then I had the opportunity in my second career at Fannie Mae to lead our affordable housing group. So, I feel very profoundly the need to be thoughtful in underwriting, particularly the way that we can increase access to things like home ownership, which is desperately needed in my mind these days. After my career at Fannie Mae, I really wanted to kind of go out in the fintech world. I joined Built Rewards really for two reasons. One is because I thought they had a tremendously innovative business model, which I'll talk about in a second. But number two is that business model I thought really gave them the opportunity to have a massive impact on renters' financial health, and things like what we're talking about today, rent reporting. So a couple words on who Built Rewards is, just to set the context and stage for what we're doing. Built Rewards is a payment platform with a loyalty program on top of it. And what I mean by that is for 70% of the top 100 property owners in this country, they've committed to using Built as the system where renters go and log in and make their rental payment every month. And for those that don't know, almost every renter pays manually. They don't use auto-pay. They manually go in and pay their rent. Our system, our payment platform that landlords use is top of the market. It's usually cheaper than the incumbents. But most importantly, it adds our loyalty program on top. What that means is every time a renter submits a rental payment, they earn points every month. And so that's an incentive for them to continue paying. And not only do they earn points on rent, but we sort of add this second part of our ecosystem, which is we realize that 80% of what renters spend their money on happens within 15 miles of their apartment. And all of those businesses that are nearby really want to get those renters to shop at their restaurant or at their pharmacy, especially when they move in and out of the neighborhood. So we saw this opportunity to connect businesses with renters and be able to get businesses to offer our points to our residents. So now, not only are residents earning points by paying their rent, which is a first, now they're also able to earn points in their neighborhood just by being a Built member. I will say, just because there's often confusion, I often get, isn't Built Rewards a credit card company? We're not a credit card company. We do offer, like Delta SkyMiles offers an Amex. We offer a co-branded credit card. About 15% of our members have our card, but the vast majority of the data that you'll see today is really driven by people that just happen to live in a building in which we are the payment platform and they're just paying the rent, however they pay the rent, ACH or whatever, on a day-to-day basis. So that's Built Rewards. I will say that, renters' health and making sure that we do right by renters is really, really important. They're our customer. We want to make sure that the landlord knows what we're doing with their customer and that we're doing something good for them. One last thing I'll say about our points, just to kind of tie it back to housing, is our points are the only points that can be used towards a down payment. Our points are actually the most valuable point of any loyalty program in the country now, but uniquely they can be used for a down payment. So a lot of how we talk to renters is let's build your financial strength to get you to the point where you're capable of owning a home. So of course, a key part of that is rent reporting. So We offer rent reporting as a completely free feature to landlords and to renters. Nobody's paying for it. No GSE is paying for it. It's free because we see the lease, we see the payments. It's easy for us to do. It's something we built and we just do it every month. In fact, we have somebody in the audience, Lauren from our team, who builds the system that does all this reporting to all 3 bureaus. It's worth noting that in addition to being free, it is opt-in. And this is important. We'll come back to this, but renters have to select opting in. You'll see pretty rapid growth here. And the reason of that rapid growth is we make it increasingly easy to just click a button while you're paying your rent to be immediately opted in to rent reporting. Move that E up, it'll say positive only. So consistent with what most of the industry is doing, we are only reporting rent when it is positive. So if somebody misses a payment, we're not reporting it. Okay, so we wanted to do rent reporting. We had heard a lot of claims that rent reporting would have 40 to 60 point benefits to renters. And we thought, wow, we absolutely have to do this. But then as we started to roll it out, we started hearing complaints. Renters would complain, landlords would complain, like something's going on with my credit score. I don't understand what's happening. So we said, well, what is happening? We don't actually see it. So really impressively, FICO put together a simulator for us, which allowed us to take a renter's credit report and just add a trade line to their existing report that showed 12 months of clean rental history, okay? The pure simulation. We take your report, we run it, and then we add a trade line, 12 months historically at your current rent payment, and we just add it on and rerun your score. And that allowed us to really understand in detail, in a more sort of controlled way for what Brett was doing, of what exactly has happened in the credit scores. Now, one other thing I will mention is we are specifically using FICO 9. Brett, if I'm right, you're using Vantage? So we're using a different credit score here. And I want to walk you through the results and some of the sort of key observations here. On the left side, you'll see we broke this down by 40-point FICO buckets, particularly focused on the lower scores. Everything 660 and higher is on that last row, so sort of all clustered together. Often people say, oh, built a program for the affluent. It is not true. We have so many renters. We have so many different observations. In this sample, you can see there's plenty of data in the lower credit score buckets to make some, to take some information away. We show you the average change to their FICO score, and then we show the overall impact. Does the score go down? Does it not change, or does it go up? So those are those 3 columns. And then we break it down by percentiles, the 10th percentile change all the way up to the 90th percentile. So a couple of key observations. The sort of big numbers that we were hearing, 40 to 60 point improvements, happen in the 10th percentile of the lowest credit scores. So the first thing to sort of take away is like these big changes are not as common as we had hoped they are. They happen, but they're not super common. The second takeaway is there is a benefit, and I think similar to what Brett was showing in his slides, in that 540 to 660 bucket, which I would sort of consider your sort of marginal mortgage consumer, we do see 10-point improvements for 25%, maybe a little bit higher, 20-point improvements for 10%. Again, mainly focused on the lower buckets, but we consider this meaningful and helpful, and it's a reason to do this. So like this is the bread and butter of why rent reporting is important. Now, it's not 40-point improvements, and it is certainly not improvements for everybody, but it is helpful to some. And then the last point I'll make is that in every range that we see, we do see the possibility that adding a purely positive trade line to a credit report decreases somebody's credit score. So that is particularly common when you get into the good credit buckets, where 10% of people can actually see their credit score go down as a result of having a positive only rental trade line. It still even happens in the lowest FICO buckets, but it's much, much rarer. And so this is one of the reasons we were hearing complaints is this sort of outcome. We do not have the answer for other scenarios. What if somebody rents for 4 months, misses a payment, comes back and makes 2 payments, misses a couple payments and gets unreported? Or what if somebody lives in a place for 4 months, moves to a place that doesn't have rent reporting, and then moves to another place that does have rent reporting? You have 4 months here and 12 months there. What if you sign a 12-month lease and then go month to month? Usually a lease is a trade line. What does month to month look like in the credit? There's so many questions that we wish we could answer. FICO's been great to give us this ability to simulate a trade line and tell us what the answer is. But I think there's just a lot of still remaining questions that we'd like to understand a little bit better as we roll this out more expansively.
Right. Yeah. Right. So I think it was very interesting because when I saw Jonathan's results and also Brett's, that you guys are using very different data sets and also different methodology. And as they mentioned, like one is using Vantage and one is using FICO, but then the overall results are largely in line that the lower credit score populations or those with very thin files tend to benefit more. And there are some people, especially in the higher end of the credit score distribution, that have more likely to experience some negative impact. So with these variations, I was wondering, how does Build communicate this information to the consumers, especially since you're opt-in program? So you have to kind of give much information for the consumers to make the right decision in this space.
Yeah, I'll answer that question in a couple other takeaways. We need more data. We need a lot more data. So I'm just going to say that up front. As people think about rent reporting, remember that it helps low credit score borrowers and it potentially hurts high credit score borrowers. So let's focus on the market that really needs it. But to your question, Jung, how do we communicate it? We're an opt-in program, and because we have this simulator, we just think it's best practice to tell somebody before they opt in what's going to happen to their credit score. And so everyone that comes into their system, they'll literally see how many points their credit score will change if they choose to enroll. And if it's going to hurt them, guess what? They don't enroll, which is a good thing. And so this opt-in and this communication is really important. And then the last thing I'll say, and we'll hear a lot more from Yvette here in a second about sort of the broader context, but rent reporting is not a silver bullet to fixing credit. It is a step in a journey. And what I love about it is once you start doing it, people engage with you on their credit. But you need to make it a journey and build more around it. And so you can see in this last part, like where we have people enroll in credit reporting, we also show them other things they can do to improve their credit. We're trying to incorporate, and you'll hear some of the innovators coming up in the next panel, but like the more we can find cool technologies to make it easy and instant for people to build better credit or change behavior, we want to do that. And ultimately, you can see a lot of this for us ladders up to what credit score do I need to become a homeowner? And how does my rent reporting affect my ability to become a homeowner? So I think building in this broader context really should be a best practice for everyone who's doing rent reporting.
Great, thank you. And then, as Jonathan mentioned, we will move to Yvette, and we will hear about what Washington Housing Conservancy is doing in this space.
So I'll start with WHC's aspiration. We are a relatively young 5-year-old 501c3 nonprofit who owns workforce housing in the region. Small aspiration here to reinvent the housing system to become a more equitable pathway to opportunity and prosperity. We acquire traditionally NOAA properties and place affordability covenants on the properties to keep them affordable to households ranging from 60% of the area median income to 120% of the area median income. So, you know, traditionally your essential workers, your working folks to prevent displacement, not force them to live further and further out from the central region, but also for them to benefit from the social capital gained in these neighborhoods that are generally targeted for, or either early in the gentrification cycle or targeted for gentrification. So I'm going to talk a little bit more about WHC, and we will get to kind of our how rental reporting leads into our mission and strategy. Our mission really is promoting housing stability in service of economic mobility. Those are where you see in the yellow, that's our North Star. We will always acquire properties in high opportunity neighborhoods where connection with your neighborhood, building that social capital, we understand those are things that are supportive of economic mobility in the long run. And our communities will always be mixed income. Our strategy, once we've provided housing stability and affordable rents, is to foster, is 4 pillars to foster connection and allow our residents, or give our residents the opportunity kind of to be economically mobile. The first is inclusive property management, where we really are trying to retrain property managers from being more transactional to creating more of a human connection with residents. Placemaking, where we're using the resources of the place in the neighborhood to support economic mobility. Community building, where we foster connection across lines of difference. These are all programming, our social impact tool, all programming that our social impact coordinators, our social impact staff implement at our sites. And then finally, human capacity and wealth building, where we are with having created housing stability for our residents, helping them to reach their personal aspirations, whether that's homeownership, which is, changed quite a bit with the recent market changes, right? Just in this region, a lot more unaffordable to get a house. But if you want to be an entrepreneur, if you want to seek workforce development skills, in many cases in our communities, folks want to learn, improve their English speaking skills. Those aspirations, helping our residents build those aspirations, is truly the tool to them achieving economic mobility. And our first sort of foray into human capacity and wealth building early on in our life as an organization was Isuzu and rental reporting. So I'll take you really quickly through our Isuzu stats. These are from last year. 80% of our residents are enrolled in the program. It sounds like, unlike Bill, it is opt-out. But our population is the population that generally benefits from the rental reporting, so that you don't feel so bad, I guess, about it. But for last year, 327 residents established credit for the first time. And so these are people who are credit invisible, who now are no longer. And of the residents who participated in Isuzu last year, 70% improved their credit score, which we're excited to see. And they can, we use that really as a launch pad, conversations about credit scores for other financial literacy, entrepreneurship, other ways for them to meet financial aspirations. So.
Great, thank you.
Mm-hmm.
I really love how WHC is kind of taking a comprehensive approach in promoting housing stability and enhancing opportunities for the residents, specifically to the rent reporting program, since this is the focus of this topic. Did you face any challenges establishing these programs? And also, do you have any future plans to maybe expand these programs?
It does come at a cost, right, to our organization. But in terms of establishing the program, there wasn't a challenge. Really, for us, our challenges are more around the general challenges in the property management industry, where it's just not very high turnover industry now. And so when you have residents interacting with the leasing staff, if the leasing team is new and not as up to date on some of the offerings that Isuzu has, then we're kind of stuck. We're losing opportunities to create that connection and start people on the path. But in terms of credit reporting itself, it hasn't been a challenge so much because we eat the cost of it, I guess.
Okay, just one quick follow-up question, because you did mention that you focus on the NOAA, and is it more like the single family or 2 to 4? Is it multifamily?
It's multifamily.
It's
so our
multifamily
properties range from 140 units to 825 units.
Because I think one of the challenges that we haven't really discussed in depth is that more challenges for the properties owned by mom and pop landlords to report their rent. So a lot of the activities is happening in the more multifamily space. But hopefully we'll get to discuss about maybe some of the potential solutions to kind of help those who are living in the mom and pop landlord space to have a greater opportunity of rent reporting if it's beneficial for them. But then we'll move on. Thank you, Yvette. We'll move on to Ethan. Last but not least, we'll hear about how rent history is being actually used in the FICO scoring models, which I think is going to be very interesting to all of you in this room, and what he also sees from the recent data.
Thanks, Jung, and hello, everyone. First of all, I really appreciate Urban Institute inviting me to participate in this panel, and I especially thank Jung, who seated me with a number of really excellent and interesting questions about trends in rental reporting, which I'm happy to spend the next few slides answering. First of all, FICO is not a credit reporting agency. However, we do receive regular randomized, anonymized, representative national samples from our 3 credit bureau partners. And so I was happy to use that to, again, answer some of the questions that Jung raised. The first of which was, what are we seeing as far as the velocity and trajectory of rental reporting in the credit bureau file? Is it growing? in prevalence. And in short, yes, it is. Just over the last 5 years alone, we've actually seen a 30-fold or over 30-fold increase in the number of rental accounts or trade lines, trades, if you prefer the more jargony term, reported in the credit file. However, that is from a very small base. A decade ago, about 2 in every 100,000 accounts that were reported to the credit bureaus were rental in nature. So while in proportional terms, we've seen this substantial increase in rental reporting, we are still looking at somewhere just below 3 million US consumers having their rental information reported in the credit file. Using a US Census, a recent US Census stat about the number of renters, adult renters we have in the US, 77 million, that tells us we have about 3.5% coverage of renters' information in the credit file. I also wanted to spend a moment talking about a profile of the rental data itself that's being furnished, first of all, of those consumers who have one or more rental trade lines in their file. We see about 2/3 of them have at least one rental trade that's open and currently active, as opposed to one that's closed, that the lease agreement has been satisfied on and they've moved on renting somewhere else. In addition, and probably more notably, 1.6% of these consumers with a rental in their credit report, a rental trade in their credit report, have a sign of delinquency or missed payment on that report. I was talking with Jonathan a little earlier, and he shared with me like the national figure for consumers who have missed payments on their rent is somewhere around 10%. So it's notable, this percentage that we're seeing in the actual credit file, 1/5 of that, that tells us that the focus very much for now with respect to furnishing of rental data in the credit file is on positive rental reporting. This table is comparing the profile, the overall profile of consumers who have one or more rental trade reported in their credit file with a benchmark, which is essentially the total population of US consumers who have a credit file. You'll note, first of all, 230 million US adults have a credit file. That leaves about 25 million or so who are so-called credit invisible. They do not have a credit file today. And I just wanted to call out, that's an area that FICO has really invested a lot of time and resources into doing something very much along the lines of what June mentioned in her introduction. We have been building alternative data-driven scores, such as FICO XD, such as Ultra FICO. These scores leverage things like cash flow information about a borrower, their telco and utility and cable bill payment information, things not found for the most part in the traditional credit file. We leverage that information in order to provide accurate scores on those consumers and make them visible to financial service providers, provide them an opportunity to be underwritten in a safe and responsible manner. Getting back to the population with 1+ rental trade lines reported, you'll see they skew younger than the total population. Perhaps not surprising when you see the next row of the table, the credit profile. In general, those with one or more rental trade lines reported, they skew towards a credit building or credit rebuilding, as the case might be, population. They are disproportionately thin file, meaning they have just a couple of accounts in their credit report. They're disproportionately new to credit, meaning they've only had credit for a couple of years. And or they are disproportionately credit blemished, which means there is signs in their payment profile, their credit history, of a serious missed payment, usually and almost always not on a rental trade line, but rather on more traditional mainstream credit, like an auto loan, credit card, and so forth. And so all this adds up to the average FICO score of the population that today has a rental trade reported in the file being materially lower than the total population, to the tune of about 65 points, which, to loop back to Brett and Jonathan's insights on the study, means that the population that today is predominantly being reported in the credit file is the population that stands to most benefit from the reporting of that data with respect to their credit score. Okay, I wanted to talk about the way in which rental data flows into the FICO score. Jonathan raised a couple of very good questions. How does a score go down from the inclusion of positive payment history? So before I get there, though, before we walk into this pie chart, I want to just underscore something June said. It is the case that FICO Score 9 was the first version of the FICO score to include rental information in the score calculation. We've carried that forward with FICO Score 10T, which is our latest and greatest version of the score. However, prior to FICO Score 9, the score does not include rental data. And there's a couple of reasons for that. First of all, it was exceedingly rare for rental data to show up in the credit file prior to the development of FICO Score 9. But in addition, what little rental data we did see in the file tended to be negative only reporting, tended to be instances where rental data was only showing up in the credit file if the consumer had not made good on their rental obligation. FICO Score 9 was the first time where in the data we were using to build that model, we saw a significant proportion of rental trades actually being reported positively, a sign that we were getting to what's called full file reporting, where both positive and negative information is reflected. Okay, with that background, let's talk a little about the FICO score calculation, how rental data flows into it. So we like to use this visual to talk about the FICO score calculation. It breaks down the calculation of the score into the 5 key categories of information that can be found in a consumer's credit file. At number 1, we have payment history. Is the borrower paying their bills as agreed? Have they missed payments? If so, how many times have they missed payments? How recently have they missed payments? How severely past due have they been? With respect to this category, it's certainly the case that positive rental data can benefit a consumer's score. And it's also the case that this is going to be most pronounced by far for consumers who really have little to no other evidence in their credit file of positive payment behavior. So to the extent a consumer already has a good number of accounts that they're paying as agreed, the addition of positive rental information is unlikely to meaningfully move the score upwards.
Ethan, can I just add one
Sure.
quick question? Because you answered this for me, I thought it was really important, which is if somebody does miss the rent payment and it goes unreported, so you have rent payment, missing data, rent payment, that's not a net, even though it doesn't show up and it probably was missed, that doesn't negatively impact credit scores.
Yeah, that's correct. So when we think about some of the biggest drivers of the payment history category, the variables, there are things like time since most recent missed payment, number of missed payments. So to the extent it's really looking for a missed payment, the absence of any payment status reported at all isn't going to adversely impact the score. That's right. Okay, the second category, outstanding debt. So here we're looking at debt levels. We're looking at credit utilization ratios. The important thing I want to call out here is by far the most weight in this category goes to revolving accounts. Those would be credit cards, followed by installment loans. This is important to note because rental obligations actually are coded in the credit reports as what are called open-ended accounts. They're neither revolving or installment. And the ramification of that is rental information is unlikely to meaningfully move the needle on this category of information. The last category I want to talk about, credit history length. This is an important one to understand. Here we're looking at things like the age of the consumer's credit file. We're looking at the average age across all of the consumer's accounts in the file. And this is important because when you add a rental trade line, whether positive only or not, you're adding a new recently opened account that can pull down that average age of accounts calculation, which could in some instances, again, have an adverse impact on the score. So just to sum up, there are both positive and negative impacts to score that can result from rental reporting. Positive from the standpoint of another positive payment, another positive example of payment history being exhibited by the consumer. Negative from the standpoint of potentially, at least in the short term, pulling down average age of accounts in that credit history length category. How these two interplay, the positive and the negative effects on the score, really comes down to the consumer's overall profile. So I'm going to just close with answering Jonathan's question. How does a consumer experience a score decrease as a result of positive rental payment being added to the file? Well, again, as Jonathan showed, that is primarily an issue with high FICO consumers. High FICO consumers are already demonstrating positive repayment history on a number of credit accounts. And because of that, for category 1 payment history, they're unlikely to get meaningfully more points as a result of that rental trade being posted. However, they could lose some points from that credit history length category from the average age of accounts being pulled down.
And John, if you don't mind, Alex, so just one other quick question. I've been told that each lease is a trade line. And so if somebody signs a 6-month lease and a 6-month lease, every time they sign a lease, it becomes a new trade line with a new unaged trade line. So ostensibly, if there are multiple trade lines that are always coming in as new, that kind of has a drag versus if we were to say, make all rent one trade line, regardless of it being multiple leases. Is that consistent with how you'd think about it?
It is. But let me give a little more color. And before I do that, I forgot to close with saying, even as we're talking about consumer scores going down in some instances, again, even in that high FICO range, as Jonathan showed, the vast majority of consumers are not seeing score decreases. 9 out of 10 consumers are not experiencing score decreases as a result of rental trades being added. So I don't want anyone to come away with the message that somehow a preponderance of consumers at high FICO ranges see their scores go down if this data is added. Not the case at all. To your question, yes, I think if another trade line is added as a result of the consumer renewing the lease, for example, that could again act on that credit history length category. It could further drag down that average age of file. So to the extent we could think about finding ways to retain that original rental trade when a consumer renews their length, I think that's definitely something that should be further explored. Even in that instance where they renew their lease, I would still say the borrower is likely to be better off, or certainly at least not worse off than they were prior to the rental trade even being added in the first place. It just may be an even more modest upward impact than what you showed.
Great, thank you so much. That was exactly the question I was going to answer
Oh, I'm sorry.
to Ethan. So I think because we have like tons of questions from the audience, so I'm just going to wrap up with one final question to all of you, and I'll go through some of the questions that we have from all the people who are listening in and also people who have joined us here today in this room. So I was wondering any of thing that you want to talk about in terms of challenges or concerns related to rent reporting and how it's included in the credit scoring models, and any thoughts and solutions to increase rental payment into the credit system, and any future directions that you see moving forward. So that's questions for you all. Anybody, please jump in to answer that question, and then we'll move on to the audience Q&A.
I'll start and maybe work our way down. We're doing a follow-on study looking at Senate Bill 1157 in California, which was passed to mandate the offering of rent reporting in assisted properties. So the challenge is really who's going to pay for this? What's the benefit? Are people aware? Are the resident services folks or the more property management folks understanding some of the nuance that's involved, and are they able to introduce that? When we've got an online entry point, that's easier to demonstrate some of this than when we're talking about people as the interface. And so, yeah, just needing to make sure that the cost, because some of these models, there is a cost that would be borne by the tenant, that really the benefit is accrued to them, and it's commensurate with what they're responsible for.
For those that know me, know that I love to pick on my former employer, so I won't miss the opportunity to do that. But I will say it in all love for my former employer, Fannie Mae. Mortgages and credit scores and how rental data interact with mortgages is really confusing. They're still using classic FICO, which doesn't, to Ethan's point, does not incorporate rental data. The way it is being incorporated is actually not through the credit bureaus, but looking at the asset statements in underwriting. And so it is being used, but it's just not using the place where we're really focused on reporting it. And so I would love to see it just be more consistent in how rental data can flow through to both mortgage underwriting, and then, where FICO score is still being used as mortgage pricing. So again, like we really want to help people build towards home ownership by reporting data to the credit bureaus, but insofar as the scores that use the bureaus aren't being used in mortgage underwriting, and they're pulling data from the asset reports, where are we in this? So I think that's one thing I'll say. The second thing I'll say is, I think last month we signed up 50,000 new clients. So we're booming. We're hoping to see much bigger numbers. The challenge of getting to people outside of the multifamily context is this idea that you've got to find the lease, confirm the lease, validate it against payments. We've actually just launched an AI system that will take any sloppy lease you can imagine and figure out all the terms you need to be able to do reporting and connect it to payments and start reporting it outside of that context. But certainly that's an area that we as an industry have to focus more on if we choose the bureau route to be the place where we want the data. If it's going to be done through asset, which is certainly a possibility, we should focus on that, make make sure that rental payments are being captured consistently in bank account data. But if it's going to be through the bureaus, we really have to figure out how to expand programs like ours to get to non-multifamily folks.
I'd just say from a practical perspective as a nonprofit, like it would be great to not have to pay to have this resource available to our residents.
I've
right?
got a solution for it.
Yeah, thank you. But otherwise, I mean, this is all fascinating to me and excited to be able to share some of it with our team.
I think my fellow panelists said it well. I'd love to move on to audience questions.
Right. So one of the, I think a lot of people mentioned about this. One of the question is like, I think all three of the data showed, and also Ethan showed in his presentation, that right now it's mostly like positive rent only. And there was a question on why we are only kind of reporting positive rents. And then the related question is like, it does show from the research that the lower credit scores or those with no credit scores are benefiting more. But then among those population, what is the share of people who are actually making positive rental payment? So if it's like just small portion of those, and a lot of like the thin filers actually are struggling to pay rent on time, the impact of positive rent reporting may not be as large as we hope to be. So any thoughts on those two questions, like why positive score only, and then like distribution of rental payment across different credit score buckets?
I'll take a stab at those. Why positive only? I mean, we've made a decision as an industry because we have, since the crisis, excluded so many people from being able to access home ownership, to find positive things to bring people into the fold versus positive and negative things where we can take some people out and put some people in. That's a decision we've made as an industry. If ultimately our goal is to improve the accuracy of underwriting models, then clearly the answer to that is collecting positive and negative. But I personally feel, you know, it's a great way for us to find those being excluded and bring them into the fold. And that continues to be something that I think is really important for us to focus on. And then the second question was on.
Yeah, among those who benefit the most, they might have like a really low share of those who are able to pay 12 or 24 a month.
I mean, we have a crisis in this country of people missing rent. I mean, I mean, the average number is extraordinarily high. And when you look at some of the categories that stand to benefit the most, I mean, we don't have exceptional data on this, but it's like 30 to 50% of payments are missed. And it's really sad when you see people who are consistently late on their rent payment, just making it just before the eviction notice goes out, and they're paying $100 late fees. But we know rent's really high. We know student loans are an issue, and we see a lot of people missing payments. So to that point, the people who stand to benefit the most, it's somewhat offset by the fact that they're making the least number of on-time payments, which was why the question Ethan answered was so important, which is, look, any on-time payments are going to help, and the ones that they miss or are late on aren't going to hurt. And so it's going to help some, but it's just going to mute the bigger numbers that I had on my chart because some of those payments just aren't going to be positive.
Two quick things to add. There is plenty of full reporting going on. So what you're hearing is what we have designed, but that is not the case everywhere, full file. And for our study, which was, kind of out in the world, that kind of study, right? We found that among those who could qualify and who were in that target range of already starting below 600, maybe 2/3 of them versus 1/3 are moving forward with positive reporting. But it's not only that they're not reporting, it could be that they moved, or there could be other reasons as well. But it's about a 2/3, 1/3 split in terms of who's reporting and benefiting.
Yeah, I think I just want to call out, I think the population that stands to benefit the most from the reporting of rental data, and you've had a stat on this population, is those who are able to establish a credit file, those who were previously credit invisible and who were able to establish a credit file through the furnishing of rental data. I think when you, Jonathan mentioned, there's some studies out there that talk about 60, 80 point increases from rental reporting. I think those averages are arrived at by saying those people started with a score of 0 and ended with a score of 620. 620 point score increase, you can, as you can imagine, that what do they call it, the flaw of averages. So I think for most people, the impact of rental data is much more modest. But for those who are simply credit invisible, many of whom are new to country or just starting their credit journey, I think they could be people who are perfectly capable of paying their rental account, on time and as agreed, and they also stand to gain the most from the furnishing of that data to the credit bureaus.
Anything to add there?
I feel like that was more of a data question.
Yeah,
than
I
a
think one of the
question.
questions to you was like whether any thoughts on whether you have any residents you think may have been negatively impacted from rent reporting. I know that Isuzu maybe pulls out when there's a missed payment or
Yeah,
but
this is only positive
Yeah.
payment as well. So, I mean, I guess to the extent that you said a small percentage of people at the experience a decrease, but I imagine that the trends in our population are no different. From
Yeah. It's usually less than 660, and it's not like a 50-point decrease. It's usually between 1 and 10 points. So you're not gonna, unless people are really looking at their credit closely, most people probably just don't notice it if it happens.
We certainly haven't received any direct feedback about it yet.
So, thank you. And there were several questions related to consumer awareness. One of the research that I briefly point out during my PowerPoint presentation was that people are unaware of the benefits and they're very misinformed. One of the surprising statistics that we saw is like among those people who said they don't report their rent to the credit bureaus, but then they answered that their credit scores increased because of on-time rental payments. So we kind of thought this is kind of weird that you're not reporting rent, but somehow you think the rent is actually impacting your credit score. So that's how much of lack of information that consumers have. So there were several questions related to how do we kind of build trust in the system and also kind of increase consumer awareness.
Well, I mean, one of the things we really appreciate about our partnership with Built is, again, we're driving increased transparency for consumers through the simulator that Jonathan spoke about, helping consumers understand ahead of time how the inclusion of their rental data in their credit file would impact their score. We think that's an important step towards making sure consumers are better informed about what the impact of rental reporting means, not just generally, but specifically for their case.
And for us, it's really a launch pad into other programming around financial literacy, where we can have those more in-depth conversations around what your credit score means and kind of decision-making around how to spend money.
Yeah, I mean, I suppose one way to do it is just mandate opt-out rent reporting across all multifamily in the multifamily context. And the downside, of course, is you may run into the situation where you're negatively impacting it. So, but you will certainly get more adoption if you do a broad opt-out. Our view, and to what Ethan's saying, like if you make it transparent, you make it really easy for people to do, like right there where they're paying their rent, you're just going to get a lot more adoption because most renters just assume that their rent's being reported, and not many are Googling like, how do I report my rent to the credit bureaus? You're just not going to get people's attention unless you make it obvious and easy for them to see.
The final question, actually maybe could be better answered by the next panelists, but then there were a couple of questions related to the fact that we are still using the old FICO score models where the rent payment is not incorporated into the credit scores. So any progress there? And then how impactful do you all think that if we use the most updated credit scores with the rental information incorporated, how would that impact access to homeownership, especially among those who had less success in accessing homeownership in this currently very challenging market?
First of all, as we saw, the key challenge with respect to rental data impacting FICO score still remains getting that data in the file. There's not going to be dramatic overarching impacts from switching to a score that does include rental data because, again, we have 3% coverage of all renters' data today in the file. That said, the big step towards adoption of the latest version of the score is really going to is driven by the FHFA's recommendation to switch to the use of FICO score 10T in the mortgage space. That's really what drives the continued use of classic FICO score in that space. So that's an exciting development because use of that score will provide more opportunities for more consumers, not just because it includes rental data, but because it's a more accurate score that identifies more consumers on the margin of what the GSEs might consider creditworthy and pushes them above that threshold. I got a stat, I think something on the order of 5% increase in approvals without increasing any of the risk taken on, thanks to the use of a more accurate FICO score 10T.
Yeah, I mean, I guess also, I mean, the GSEs have a very confusing system, right? They use their own credit scoring models. Right now, they're using rental data from asset reports. If the data that Brett and I shared is true and reflected in how they're thinking about rental data, it means there's, you know, a chunk of people that are right below being approvable, they're gonna get pushed in. So that we should see that functionally in a very different way. When we move to FICO 9 or FICO 10, I think the more important aspect is going to be improving pricing, both the mortgage insurance pricing and the GSE LLPAs. Right now, if they're not based on rental data, but if they are, we can see substantial savings for some people as a result of rental data being in there.
Right. Anything else that you want to mention? So thank you so much for all our panelists for sharing your valuable insights. Thank you again for those of you who are here. I personally changed my flight to Korea after knowing that this event was going to happen today. And I'm so happy that I did. I learned so much from all of you today. And I hope you also enjoyed the first panelist, and there are also all the upcoming panelists to come. So thank you, everybody.
So I just got a message from the event team that I have to entertain you while the second team is going to be mic'd up. So I am going to introduce our next panel moderator, who is Christy Johnson, the Vice President of External Affairs at Prosperity Now. And as we mentioned, we are going to look into what innovations can help consumers build credit. And while they're still not out, so maybe I can do a dance, but then not for today. But thank you, everybody. So they will come out very shortly.
Okay, panel 2.
Feels a little, but yeah. Other than just excluding it.
Thank you, Lily. Oh, nice. Okay, we're all here. So full disclosure, we were all fully mic'd back there. We were just really hoping that Jung would do a dance. That didn't happen, sadly. Just kidding.
Do a dance.
She did offer one.
Wow.
So welcome to the second panel of 3 today, our little meat in the sandwich. What innovations can help consumers build credit? So innovation, that word is so hot right now. I think we use it a lot as a placeholder for things, but I actually wanted to pull up the real definition of it today. And it is the practice of putting new ideas into action, straightforward. So whether that's thinking about existing practices or products and improving them, or coming up with new ones, innovation thinks of that and puts it into practice. And so that's what we're talking about today. Lawless said Jonathan, I call him Lawless because with a name like Lawless, you got to go by Lawless, right? He said something in the last panel about the rent reporting is not a silver bullet. It is a spark in the journey. And however, sadly, for so many people, they have in that journey, they're facing barriers still, systemic barriers that are affecting their ability to build credit. And what we're talking about today are these sparks, additional sparks, in addition to rent reporting, that really ignite that fire of innovation to break down those barriers for consumers. So before I turn it over to my esteemed panelists, I do want to remind you of all of these table tents on the tables that have QR codes. We will be opening up the last 10 minutes or so for questions. So please take advantage of those QR codes to ensure that your inquiries are accounted for. So I'm going to turn it over to each of you. So you each represent I need to stop hitting this. You each represent a company that offers unique solutions for consumers to build credit. Can you please briefly introduce yourself and your organization and your approach to credit building and one innovation that you think is having maybe the greatest impact for you?
I can start. Hi, everyone. Thanks for having me here. My name is Manish Garg. I head up our product and engineering teams at Arnab. We are based out of San Francisco Bay Area. We have people all over the country, though. Arnab's been around for over 10 years now, about 11 years or so. We started out our journey by really helping people achieve financial wellness, by helping them make payments towards most of their debt categories, helping them make payments, especially for people who live paycheck to paycheck, but then we've gone beyond that. But the core premise is still the same, that allow people to make payments towards their loan when they get paid, because a lot of people who live LMI or LMI users, low mid income users, they spend their first half of the paycheck, and by the time they reach the second half, they don't have enough left to make those payments, and they keep falling further and further down in the hole of debt. So that was our original premise, and since then we all obviously expanded our offering, and we help people pay their debt, create more savings. And your second part of the question, one innovation that we've recently seen surface, no surprises there. In the last 2 years or so, we've obviously seen a prevalence of AI and being able to imbibe that into what we do. And we'll talk about that a little bit more in a minute or so once we've all gone through our introduction. But finally, I personally feel that the playing field will be level a little bit, because it's truly going to democratize access to information for the people who need it the most, but have had the least access to information to improve their credit. And that'll be a topic we can talk about a little bit in a minute. With that, I'll hand it over to you.
Thank you. And thanks again also for being here. Christian Lund. I'm SVP of Alternative Data and Market Innovation at Self Financial. I came over to Self as a co-founder of the first rent reporting company, which I think we'll also talk about later, just a bit, because we've talked a lot today for it. So I'll focus a little bit more on credit building. So Self Financial, we got into credit building about 10 years ago by trying to really scale this, what's called a standard credit builder loan. And what the credit builder loan is it's a pretty simple concept. It's you pay a small sum per month, say $25. The goal is that you can build savings with that. That payment gets reported to all three credit bureaus as an installment loan. It has a lot of benefits, and these benefits are kind of like when you talk about like your business foundations. The benefits, those benefits are really like a couple things. One is it builds positive habits. So people who need credit building at the end of the day, are either new to credit or low credit, and that's who we serve. The first thing we want to do is we want to ensure that we help teach them and help give them a guide to build positive habits. Positive habits are what's going to be the foundation for their ability to go into any other financial product. It's going to be their ability to understand and get educated about the credit system and the financial system as a whole. So we find it really, really critical to help our builders build these financial positive habits. And then what we do and scale that out is we've added on what's called a secured credit card. A lot of people know what that is historically. The big thing at Self, and kind of just finishing on our innovation, is at Self, we found that almost nobody could afford just giving up $500 to get into a secured credit card with the intent of then be able to get access to unsecured credit eventually. So what we did, which I think is still innovative, and we're still trying to find ways to continue to innovate on it, is we've allowed builders to use their incremental savings that they've put into their credit builder loan to securitize a credit card for them. And then what we're able to do is we're able to issue a card, and then we're able to really teach a lot more about credit and the credit system. So an installment loan, building positive habits, a secured credit card, learning about utilization, learning about purchases, learning about paying off balances, et cetera. You've got to do it all on your own. And then the last thing I'll say about the Self platform and why I think it's important to call out is we want to make sure that we're always delivering what we call a real trade line. Meaning, if you don't use the product well, it will have consequences. If you have a secured card and you don't make a payment, it will get reported as derogatory or late. And we do that because we want to maintain the sanctity of the lending environment. We want these trade lines to be trusted by lenders. If we find that really important, I think that's a key aspect to credit building going forward. So it's really important for us. And so kind of in closing, like what I think, we are a low to no credit company, and we are trying to continue to use both traditional and alternative products across our platform to help consumers build credit.
Thank you so much. Lamine Zarad, founder and CEO of a company called StellarFi. I built 2 other fintechs in the past, both were neobanks. So this is the first time kind of venturing out in the consumer credit space. Before then, a lengthy career in financial services, everything from the private sector with financial institutions like Bank of America, Merrill Lynch, to a public sector. I was a banking examiner with the OCC. So part of the reason why we started StellarFi is just our general dissatisfaction with products in the credit building space. We recognize that there are 2 needs. One, to help consumer build better habits and create discipline around repayment. And the other is to actually build credit. Anything in alternative attributes reporting or goes to models that are not used by decision makers or lenders. And it creates more frustration than satisfaction. And this certainly does not help consumers. And so we thought, how do we marry the concept of taking these alternative data points, because these consumers are engaging in activities monthly where they're paying recurring bills that should be counted, but sometimes are completely invisible. Rent is being one of them, but there are many other things, utilities, subscriptions, and so forth. And how do we consolidate all this and then engineer a trade line that propagates into every single FICO model, Vantage model across board, right? Instead of creating some alternative format that then we would have to convince lenders to use or incentivize lenders to use. And so what we did is we created a really interesting product that leads with bill pay. We said everyone pays bills. 1 in 3 Americans is habitually late in paying their bills. How can we help them pay their bills on time? Well, let's consolidate their bills on our platform. We'll pay those bills using a revolving line of credit with a card as a front end, but you can also pay those bills using ACH if the bill doesn't accept the card. And that revolver is now a revolving trade line, which reflects on your credit report. If you guys remember the FICO breakdown, the credit utilization is such an important component here. It's exceptionally impactful. And now you have credit utilization that reflects the bills that you've been paying. You otherwise wouldn't qualify for a line of credit anywhere else, or at least a line of credit this size. It has a massive impact on your profile. So in many different ways, it impacts you in a positive way. It reflects your actual payment history. We do report negative because we, just like you guys, we believe in not distorting credit profiles and cooperating with the industry. Ultimately, we want to build better borrowers. So yeah, let me stop here.
So taking this, and you each gave an excellent description of your companies. I want to take it to the next step, which is a little bit more on your products. So we're going to start with EarnUp. You made some really cool announcements recently around AI and what it can do for consumers, and you hinted to it a little bit before. Can you share a little bit more about that product and how you're seeing it may uniquely affect this outcome for consumers?
Yeah, sure. Happy to do that. Our grand vision is to eventually build something equivalent to a self-driving car for the financial industry, where AI and manual intervention can help drive better results for the consumers, whether it's driven by the consumers themselves or the technology is helping them drive those. And with everything that's been introduced in the field in the last 2 years or so, and I'm sure many of us have heard of all of those innovations, have really enabled us to finally be able to achieve that, and we can start to see that this picture can become real. Still in infancy. I think AI is still what internet was in early to mid 90s. So there's a lot of things that are going to happen, which none of us really know where it's going to go really. But I think if we peel the layers, there are really different layers, right? So at the core, obviously, the ability for consumers to interact with our models, which we've purpose-built for financial advice and financial well-being. We've taken existing models and customized them for those needs. And then layering on top of that, individuals' personal financial data, whether it's data that's coming from their banks, that the data that's coming from their credit lines. We have partners who provide us all of that data. And then ultimately providing them very customized, bespoke action plan, and then taking it to the next level, which is integrating it to our final product, which is not only do we tell them, hey, here are all the things that you can do to improve your credit or become more credit worthy or being able to save enough for a down payment, but this is how you do it. Click here and we'll onboard you onto a platform. So providing advice is great, but you really need to take them to be able to take action and make it really easy and simple. Otherwise, that's where people get confused and lost, right? I know what all of this means. I really don't know how to do it. And so on a click of a button, you can create your savings, you can start paying off your debt and a lot of other great things that we can do. So it's almost like a value pyramid, right? Like going from more generic stuff to making it more and more personalized and eventually being able to take actions. And finally, automating those actions. So many times users won't even have to act on them and it can all be automated. And we've built a lot of layers of compliance and risk and making sure that this is a really safe way for people to be interacting with these systems. And again, we'll talk about all of those in a minute, but that's sort of our grand vision of how we bring our existing technologies and how we weave AI into where the world is going.
I have so much follow-up for that, but I want to get through these products first. So let's go down the line. A little bit more about the self-rent reporting product and maybe some success stories that you can share would be wonderful.
Absolutely. So as I mentioned, I co-founded RentTrack in 2013, which was the first company to report rent to all 3 bureaus. It was a very trying, topsy-turvy process, but what we were able to learn during that time is how do we get access to a lot of the rental data necessary to furnish data in a fair and accurate way. And as part of that, we were able to integrate with multiple property management systems. Just kind of going back to the history here of what Self has been able to do for us is as we integrated with multiple property management systems, we were able to access public records. And we were, over the course of about 6 or 7 years, as we processed rental payments and reported rental payments, we were able to build up a really huge corpus of rental data, really probably the largest in the country. And what that gave us the ability to do was really build an LLM and machine learning on top of that. And so with the acquisition of my company by Self, what Self really did is they really accelerated our investment into the automation and of the verification and accuracy of the rental data so that we could ultimately, as of last year, we've been offering rent reporting for totally free. So anybody, mom and pop shops, multifamily, affordable, no matter your housing segment, what we've done at Self is we've said, we want rental reporting to be a free option for anybody who we can verify and validate on our platform. And it's been pretty successful because as a previous panelist called out, rental reporting has been pretty ubiquitous since we started it in 2013 at major multifamilies. So those top 100, top 200 property management companies, they've been able to report rent. People who can live there and afford to live there have been able to have the access to it. We really wanted to democratize and make sure anybody who could do it was able to on our platform. So you could come from a multifamily, you could come from a single family. We've built the technology and the underlying framework so that no matter kind of who you are and where you come from, as long as you can have a bank payment, as long as you've got some type of documentation, we can use our LLM and our AI, which is able to extract structured data, put that together and verify you, and then have other waterfall processes to do it. So that was really our ability to scale and bring rent reporting to everyone for free. So that has turned into a couple of success stories, as you asked. One of my more favorite kind of recent ones is we had one of our partners is Pathway Homes. They are a company that does rent to own, and they want to bring people in from the margins, people who don't have the down payment, don't have the credit savvy or the credit worthiness to own a home, and they want to give them a path towards it. hence Pathway. And we're a partner of theirs. And so we collectively, they referred somebody who had a tragedy in their life and wanted to really have home ownership for her and her daughter. And she was able to use our platform for a couple of months, report her rent, report her historical rent, and then get qualified for a mortgage and then get into home ownership. And we've got, like thousands of stories like that. That one was a really fun one because I really like when another technology comes in, like rent to own, or partial home ownerships, and they can take kind of multi pieces of the environment, the ecosystem, to benefit consumers. So we did that. That's been successful. We're going to continue to scale that approach.
I mean, I'm going to open up to you, and then we're going to lead into the next question. So I want to hear more about your bill payment reporting model, and really how, so what are some of the barriers that you've seen broken down for consumers? And with that all in mind, and thinking about all of us as we lead into the next question, what have been some implementation barriers for you, whether it's building trust, leveraging the building of trust with the implementation of technology? I'd love to hear about some of those challenges and maybe mitigation strategies that you've taken in that as well.
Yeah, sounds good. All the above, by the way. So let me start by explaining what we're not, and we can talk about what we are and then the challenges. So there are 4 ways to build credit. The most conventional is an unsecured card. You get a credit card and you pay that credit card off and you build credit, right? It's reflected as a trade line. Then there's a secured card or secured loan product that you can take. You talked about it. That's another way to build credit. The reason I say 4 is because it can be a card, it can be a loan. And then last but not least, it's rent reporting, utilities reporting. This is the youngest, the newest, the sexiest way to build credit. And there are quite a few entities doing it, including Experian, right, as a big bureau with their product. And so when we looked at the landscape, we said, all right, credit card is the most effective, but it's the riskiest, right? If you're a startup, you're going to lose your pants. If you get into the space where folks are clearly not paying on their loans for the most part and their trade lines, how do you get it done in a way that doesn't expose you to all the risk? We don't want to do secured because huge barriers to entry, because it requires people putting some meaningful amount of money down in order for the trade line to be reflected on their profile to actually have an impact. And then, as I said earlier, the rent reporting is just ineffective, right? It doesn't really affect your credit scores that matter to our consumers. You can't go and buy a car because you've reported rent, at least not yet. And so we wanted to really have that rent reporting experience that's smooth, that's frictionless, but have the impact that the unsecured card has. And so what we created is a really interesting product. We just reverse engineered a credit card. And we said, here's a bill pay app. You find the billers in our system, be it Netflix or Amway Property Management. You link it by logging in our app into that bill. And what we do is we create a card that then goes on file with a bill that is used to pay that bill. And we do pay that bill for you using our balance sheet, right? So we create a trade line that is as conventional as it gets, and then you pay us back. What's unique about our product is that it's a card that's boxed off. In other words, you can't take that card and buy a pair of shoes or something that is not recurring. So we really sort of cut off the long tail that represents risk for a lot of creditors. And we said, let's give people the opportunity to use a higher credit limit on things they're already paying anyway. So we reduce the risk for ourselves as a company while giving them something of value. And that value is big trade line that really overhauls their credit profile and reporting positive payments in our trade line. As you remember, that was a massive impact on the score. And so that's what makes us unique. The challenge, of course, is education. The biggest challenge in this space is that consumers have access to the internet. And we live, I think, in a world that currently is experiencing a digital media literacy crisis. It's like living in a library, not knowing how to read. And so folks are making things up. And unfortunately, there's a lot of misinformation, either from other players that are in a space or individuals who just set up websites or set up pages of sorts and try to educate people how to game the system. And that is the single biggest challenge in re-educating people how credit works, what you should do, how you should be responsible with your credit, and of course, building trust. And so what we learn and what works for us as a direct consumer company is actually going through other brands that already created trust, financial institutions, other fintechs with an established track record. FICO, for example, worked with FICO's consumer-facing arm, MyFICO, and so forth. When you create trust and you've established that trust and you say, look, we know everything about your finances, here's a product that works really well. It tends to help consumers get over some of the barriers, some uncertainty, and make right decisions.
And then open up to the rest of the panel too. Any thoughts on, the adoption, implementation, barriers of trust? And well, I know everyone is trying to do right by consumers. We do live in a world where they have been harmed by some very predatory practices and tools in the past. So how do we empower consumers to better understand, be able to read in this library? What are the ones that will help you? Because there are still some, and then what are the ones that may not? And then when you find the ones that will help you, how do you build that trust to get them to actually adopt it? AI is a prime example because there's a risk there when we talk about those systems, if we're not intentional, of replicating some of the bad actions that occurred. So how do we overcome this?
So I can start with at least one thing. So stepping back, like really lo-fi, not even that high of a tech here, but what we've done over the years. So before I even go there, about 95% of the users on our platform, which is by the way available both as direct to consumer and also we white label it to financial institutions, 95% of the people on our platform are paying their debt on more than a monthly frequency, which means they pay every other week or bi-weekly and such, even in scenarios where, especially mortgage, where servicers don't accept it. So we've helped them pay that off. And as they do that, we've built in technology, calculations, etc., that allow people to enter their numbers like, this is my mortgage amount, this is my interest rate, this is how many years I've still left to pay. And then we show them calculations. If you accelerate your payments, if you add additional $50 of principal, $100 of principal, or if you add a 12th of your payment every month and accelerate it a little bit, how much can you save? And it's astounding. In today's interest rate market, that's a 6% for a mortgage of a home, $400,000, a 30-year mortgage, an average user, and I'm going to throw ranges here because these things vary on a lot of things, can save somewhere between $110,000 to $140,000 over the life of the loan and save about 4 to 6 years in terms of how quickly they can pay their loan off. So a 30-year mortgage they can pay off in 25, 26 years instead. Obviously, they're going to refinance along the way, but that's how much they can save in interest. And people do not know that. And now when you think about the interest that they have to pay on things like credit cards, etc., and a lot of people have revolving credit lines and they're not paying their full balances, saving, the total number may be smaller because the loan amount is smaller, but the amount of savings they can have on interest is just astounding. And I didn't know that till I put my numbers in the calculator too. So a lot of us who are reasonably financially more astute are also not aware of such savings. And these are just such low-hanging fruits that everyone should have access to this information and be able to leverage it. And people don't. So we try to educate people through tools that we provide to them, which are simple to use. This is not even AI, right? This is just calculations that you can easily crunch in, and we make that available to everyone. So that's one example where we've seen a lot of uptake. And what is most fulfilling about all of this is we regularly get calls, and there are tons of testimonials out there where people call us and thank us, some of them even in tears out of joy, helping them pay off their loan and finally own the home. So it's truly very rewarding to be able to do that. So there are many such low-hanging fruits and tools that could be provided, which are not technically that sophisticated. So that's at least one that I can recall.
Yeah, I think the way that we have worked at overcoming it, we have the luxury of being around for 10 years. So you can go to an app store and see millions of downloads or hundreds of thousands of reviews. So there's some level of just social trust that you can do, but that's not something you can do out of the gate. So as Lamina called out, I think the two ways that we think about overcoming obstacles from a trust and education perspective is one is about 25% of our members or our builders heard of us through friends or family. So we have really tried to build up a community in ways for our community to interact and share and communicate in a way that seems more authentic and independent from us. And that's really gives you like our community a chance to within our app or within how they share it or we refer it, talk about what works for them or what doesn't work for them. And it comes from real people, so it's an authentic way to communicate. One of the exciting things about AI, right, is that you can use AI to start to simplify how users can share and talk about it and still maintain a level of authenticity. I'm excited about some of the tools that are coming down the pipeline for that we leverage. But I really think you have to organically and authentically allow your members to communicate to others about yourself, how to share it. But it's a hard balance to strike because even if the next generation believes that an AI assistant is going to help them with their finance and credit, there's a level of I think inauthenticity that comes with that you've got to balance. And I think that's really what I think you're calling that, which is like, how do you ensure that as you get more automation and can scale that and get more knowledge, how do you maintain like the education, the community authenticity? And we really are focusing on that and what we're doing today. And that's really through what I call our community and how we do that.
So finding a way to bring almost the human into it, that brings that authenticity, that community that you talked about, that human element. So consumers aren't the only adoption barrier. There's also this wild card environment that we are in right now with who knows what's going to happen in the regulatory space, but we do know that there are some levers that can be pulled to either progress or limit progress here. So thinking about that space and the runway that lies ahead, what are some of the levers, the regulatory levers that could help or, like I said, inhibit the progress of adoption of these around these types of innovations that could really help consumers? Open banking comes to mind, any type of AI regulation, special purpose credit programs. How's that all going to play out for you? How are you going to approach that? Moving too slow, too fast?
I can start. I'll start with a sort of a broad thought here. You guys want to dive in deeper. Well, innovation needs goalposts that are relatively stable, right? And you can start planning around those goalposts and creating, things that can thrive in an environment that has some degree of stability. And so one thing that I think we can do from the regulatory perspective is create stability and predictability of where we're headed. It's not government's role to innovate. And I think sometimes the government forgets, or at least is pushed in that direction into believing that it can innovate. It's a broad sword. You don't want to swing it, right? You don't want to swing it hard. You want to be very careful because there are externalities. There's second order effects and things of that nature that I think a lot of times policymakers are just not considering. And so it creates panic frequently when that sword is being moved around really fast, and it inhibits innovation at the end of the day. And we're seeing that. The past, I think, 18 months have been kind of devastating for fintech in general because financial institutions that have been supporting fintech, and fintech does not exist in a vacuum. Fintech is very much a thing that lives on top of financial institutions. And those institutions are taking a lot of risk in allowing companies like my company, for example, to do what we do, because they don't really understand how the thing works. And we're sort of learning as we're building this plane. And so I think regulators should be working closely with financial institutions, not necessarily with fintechs. I know it's a thing that all of us would very much love to have direct connection to the government, but we don't need that. We need to have a stable relationship with banks, and banks need to have clear guidance from their respective regulators. And lengthy timelines, how to improve things, how to tweak things, versus regulation through enforcement or enforcement action, I should say. I think that's the biggest problem that we're facing today. It creates volatility, and frankly, there are companies that existed 2 years ago and no longer around, not because they were bad companies, because the financial institutions did not know what to do with them anymore.
Yeah, I think that I was at a policy summit a couple of weeks ago, and I think the three key things that really came out of there that were really generally true in fintech, and this is fintech, and that goes beyond credit building to Lameen's point. Goes to the sponsor banks that enable fintechs to bring products. One of the first key things is that our industry was the one who developed the unit economics to give low to moderate income, low score, no score people actual access to the credit and financial system. These are people, remember, who were underbanked or unbanked. And when you look at the latest reports of how that number has just fallen dramatically with the advent of a lot of the technologies that the fintechs have brought to the market, it's because these companies are able to innovate and foster ideas and invest in an environment that supports it. And that's really critical with guardrails. So certainly that's huge. And I think that was a real common theme that came up across the board there. And then the other that I'll bring up without dominating the stage is at the end of the day, consumer protections are critical. That's why, why you want guardrails. It's why our federal regulator partners are in this space, and you want to maintain that sanctity. But at the end of the day, of course, in order to maintain that unit economic relationship, right, we need the regulators to ensure that they understand and create environments for us to collaborate with them. And so like an AI is an example where it is moving so fast. And there's some interesting proposals out there about creating some sandboxes with regulators and letting the private sector have like secure ways to create compliance and controls around it. I'm really pushing for that as well. I think all of us would really benefit from ways to collaborate and then generate these new ideas and then make sure that we've got the right guardrails in place so that companies like ours and the rest of us up here can actually invest to bring better products and services to the low to moderate income space.
Yeah, thanks. I'll add just a little bit more to that. I mean, we've helped move hundreds of millions of dollars over the years that we've existed as a business, so we understand and practice a lot of regulatory and compliance requirements of the financial industry. What we are seeing, and more specifically now moving towards AI, what we are seeing and hearing from a lot of financial institutions that we work with, so we've tried to distill it into what I'll call an acronym PATH. So privacy of people's information, making sure that's all well encrypted, kept in a way that it's not easily accessible by any malicious intent. Is auditability. There's a lot of need for being able to audit the models which are creating the outputs that people see. So being able to see what is going on behind the scenes, what kind of responses are coming back, and being able to view them by the risk and compliance teams internally inside of the banks and other financial institutions. And then transparency of the models, which is what is going into the models and how are models coming up with the kind of responses and making it available to the consumer. So when we provide any response to the consumer, we also have a section there like click here and see how and why it generated these responses. So it really walks through the whole logic, which is somewhat of a novel thing that we've invented along the way as we've been working with the bank. And then finally, Edge is humans in the loop, no matter what. Like we do want to have a fail safe and we want to have an exception handling process where we have humans in the loop who are checking the work, and if there's an exception, then eventually it gets passed over to a human, which I don't think is going to be replaceable anytime soon. So that's kind of how we think about all of these things. And that's one way to think about it. Is I'm obviously oversimplifying this, a lot of dirt behind all of this, but that's a common theme I've seen with a lot of financial institutions is what they look for.
So as we talk about this, I mean, you mentioned enforcement action as one outcome there, but it also is on all of us as financial institutions as well, especially when we're talking about alternative data or anything or innovation. We are talking about reaching people who have been left out. And that is primarily because of the way the system was built, low to moderate income consumers and communities of color. So as you build your own products with intentionality, regardless of what's happening in the government with enforcement or anything like that, how are you making sure that your products prioritize and protect those consumers that we are trying to reach?
I'll start structurally, right? So you have to build a company designed for that specific purpose. You can't build a general purpose company and then, as an afterthought say, well, we're going to go after, low income consumers. We build a company that helps people pay their bills. Guess who needs help paying their bills? It was actually a surprise to us when we started growing and reached close to 1 million users, realized that wait, we have high income users on the platform too. We did not market to high income users. We did not market to anyone who needed help paying their bills, and then realized that high income households in this country, half of them live paycheck to paycheck as well, which is fascinating. And it was an incredible discovery for us. But generally speaking, if you want to serve a certain demographic, you need to build a company specifically designed to serve the demographic. And I think that's the problem, right? Structurally, we have financial services as an industry that is very much revolving around high income consumer because that's where you make your money. It's very difficult to make money, sort of a long tail. I mean, it kind of is just the basic principle where there's lack of standardization, difficulty in accessing that demographic. It's very difficult to put your product in front of them. And so yeah, I mean, you have to build a company that serves them, but you also then have to partner up with companies with reach. I think Built Rewards is probably an amazing example of that. A distribution model is brilliant going to, through centralized ways to access, housing market versus knocking on every mom and pop's door.
Yeah, that makes a lot of, I agree with all of that. That makes sense. I think the two key things I'll reiterate and then go into depth on one is you do have to be purpose built. That's how you prioritize. That's how you are going after supporting and empowering an audience that was left out and is continuing to still struggle. So your company, your mission, and who you really partner with and create in your ecosystem has to be aligned to that. And so that's a big part of how we kind of answer the question of like, how do we ensure that they stay the priority? We've worked really hard at generating a lot of nonprofit partnerships like the Financial Health Network, Operation Hope, Spring 4, Pathway Home, or Pathway Homes, not profit, but like these partnerships where the companies, yourself, your missions are aligned. You're helping someone in their journey, whether that's on the debt management side, credit counseling side, to the credit building side, and through that financial journey into the mainstream and helping them along the way. The more you can create an ecosystem for these people in order to help them get from where they are to where they would like to go, maybe home ownership, maybe just getting a car, whatever it is, you got to have that ecosystem in place that all is missionally aligned to it. That does not happen overnight. I will tell you, nonprofits are very protective of who they help, and so you've really, if you can get in and work with them closely, and their credit counseling and there are people on the ground, that's certainly been a way that we've felt like we can make a difference. And I always encourage anybody who's working with low to moderate income, like the nonprofit sector really has established themselves so well with ensuring that like who they talk to, how they talk to them, you can learn so much, and we've really tried to embrace that as we've scaled our products digitally.
The nonprofit sector loves a private sector group willing to be proactively engaged with us. So right on. I don't know if you have any thoughts.
No, we can.
Okay, so I've received a big sign over there that says time to move to Q&A. So I do have a few questions for you, and then I have a final question for all of you. But first, from the audience, as a reminder, those QR codes are right there. Well, I appreciate the way fintech companies are focused on building habits and behavior change and also have tools and products to fill gaps. I'm struck by the way these innovations have assumptions about LMI individuals and borrowers and put the responsibility solely on the individual. What are some innovations to also address the way systems harm and reinforce harm for LMI consumers, disproportionately people of color?
It's a big one. I think I'll take a stab and then I'll pass it on to you guys. I think it's a very valid question. Credit can be good or bad, right? Like generally as the commercial system, there is more and more of a push to push more credit products towards consumers, whether they're able to absorb that or not. And that has been harmful, right? Because especially for LMI population, high interest bearing loans can be very crippling to their financial health. And sometimes without full knowledge of what they are taking on, people end up taking on these products because that's the only way out that they can see sometimes. And helping people be educated about the products that they are taking over is really important. So one of the things that we are investigating right now is before you even give out a card or before you give out a financial product to the people, are they able to run a simulation to see what happens when if I use this product? Like, what is the financial impact it has on me? This is how much income I make. Here's my bank account information. Here's how much income I have. These are my other expenses. These are all my discretionary, non-discretionary expenses. How much can I actually afford? I'm not sure how much of that goes into it, right? So helping people understand that is really important, and being able to understand it on their own. That's one. And secondly, that's where I think that the distribution model and the partnerships become really important. And that's why all these tools are not necessarily the best tools for direct to consumer, but also our ability to provide those tools to financial institutions and credit unions and every such company out there, so that they can then fine tune these offerings based on the kind of consumers that they serve, because they all have a specific niche that they serve, and being able to address their communities. I don't think one generic company can serve all of the population segments very effectively, and every financial institution knows how to serve their population in the way that best serves them. So being able to have the distribution model is really important. And one of the reasons why we white label everything that we sell, so that we can provide that technology to anyone who's willing to work with us, whether for profit or non-profit.
A specific example on what you said regarding education. I think one of the things that's sort of taken for granted by virtually everyone in financial technology and financial services is that education is very expensive, right? And what I mean by that, even if you present it for free, it's expensive to process that information. It requires a lot of calories that you as a person should be allocating somewhere else in your life, especially low to middle income type households. And we create the content that's a very difficult process. It's generic. It's not really directly affecting your life per se. It requires sort of long-term thinking, and we assume that that's the content. Just it's presumptuous in many different ways. And so what we've been struggling with as a company is how do we take that content, still provide what we want in terms of education, but present it in a way that's palatable. In a way that's actionable, even where you can widgetize your learning and you get something tangible in return, like potentially points that you can cash out for bills. And so now your utilities are cheaper because you learned something new. And so that's kind of what I think sort of innovation. Well, companies that want to innovate in a way that helps specific demographics that need help are doing, right? And kind of creating these widgetized experiences.
Yes, people have gotten really existential in their questions here, so I'm excited. They've gotten deep here. And I don't know if you wanted to weigh in, Christian. I'll let you do your thing. I hate when that happens too. But their next question was, do you all think the overall or the system of credit score is worthwhile overall? All seem engaged in improving the current system, but does the system overall work, and is it worthwhile? What alternatives could exist, and are any of you working towards that?
I'll take that one. So I have a very dystopian view. I think I'm an immigrant, and the American dream is very linear, right? It's algorithmic in many different ways. I think we are moving toward some master score of sorts. And frankly, FICO has done a fantastic job developing a score that represents people's ability to repay and their intent to repay. And everything that we do now, everything from your education to the type of work that you do, can be distilled numerically into some sort of a score. I'm not saying that's a great thing for the society, but I think that's where we're headed. I mean, look at cars now. Tesla has a score for your driving, the ways you drive and things of that nature are going to become prevalent. And so whether it's good or bad, I think it's a different philosophical debate. I think we need to accept the reality, and what we need to do is we need to sort of level the playing field, because it's going to create inequality and it's going to widen the gaps and so forth. And we need to take information that's currently not available to these systems, that is not captured, and put it up there. So it is available and it is captured. So it actually represents you as a human being, and who you are, and your intent, and your willingness to pay and so forth. So yes, and statistically speaking, FICO is still the most effective way to predict whether you're going to pay or not, right? FICO models. And so we just need to help FICO be better. We need to help, and this is what we do. We're not trying to reinvent the wheel. We're saying that works, but it doesn't work good enough. Let's give it more data and make it work better.
I will just add on one quick thing, and I apologize. I think I understand the systemic challenge, and I agree with it generally speaking that that has held some low to moderate income the segment down a little bit, and so much is based on that score. One of the things I'm most excited about coming is open banking. I think open banking is going to more empower consumers who are deciding what they share, additional information about them that can be very valuable when someone wants to determine their credit worthiness. I think cash flow data is coming. It's been around. It's getting better. That's augmenting it. I think there's other aspects that are coming with open banking and open finance that are pretty exciting that will help, I will say, disrupt the system, not necessarily replace anything, but I think there's some disruptions that are on the horizon that are going to be good for all consumers.
So in this final minute, I'd like to open up to all of you as we're thinking about the future. So what do you think as you're looking ahead at the landscape? Are there any real emerging technologies, processes, policies that you really think are going to be the catalyst, the game changer for what's to come? What are you excited about?
Do you want to go?
Okay, I'll start.
Yeah.
So I just want to start from the point of view of consumers and how we sort of think about the different demographics, and then talk about technology a little bit in a minute. There was a very good report from OCC a few years ago that came out that talked about at least 3 life stages of a financial journey for not necessarily everyone goes through the same financial journey, but like people can be at different points and hopefully they move upward. And that's starting with just security in their financial needs. Like, do I have the security to make my immediate payments? Can I make my car payments? What happens if my tire busts? Could I go to work? And then if I don't, then what happens? Just security around immediate payments that you can make. And then the next one up is resiliency. I have security, but I don't have resiliency. If something bad happens, like, can I survive for a month or 2 months or 6 months perhaps, which is ideal. But being able to move from security to resilience, and how do we help people move from bucket A to bucket B? And then finally, stability, which means now I have those things taken care of. And now I can think of my long term. I can think of my retirement. People in the first 2 buckets cannot think of their retirement and their life savings and all of the good stuff, saving for their kids' education. It's all good to talk about that, but there's a vast population of people who are not even living in the world where they have the luxury to think about these things. So it's somewhat, I think we need to think at that level, right? Like being able to create the right tools and solutions for the people who are living in each of these categories and who are struggling really. Otherwise, we provide solutions which are not really aligned with the lifestyle and what people are doing. So I think tech comes first. First, understanding where the people live and struggle with is more important, and that's sort of how I think about that.
Yeah, I think I'm excited about the people having more access to data, like I just mentioned previously. So when I think of the like what's coming and what to look forward to and why people should be optimistic, it's that there is a big movement underway, and that movement is bringing more power and information to consumers' fingertips. I agree. There's, you've got to ensure that there are, the legal and the compliance components and guardrails are in place. I do worry about that. We know that models today, we know there's a level of systemic racism that can be used in models, and then ultimately that can come out in responses. Google and chat. I mean, there's been a lot of very high profile cases where you've got to ensure the information that goes in is helping and improving and then providing information that comes out that is beneficial. And so there's these guardrails, but I'm really confident in the pace and the rate that things are moving at, as long as we ensure that we've got the guardrails for it, ensuring that the data in and the quality of it, and as Nisha said, like the ability to audit it is all in place. And everything I'm hearing out there, whether it's at the policy level, at the private sector level, everyone I'm talking to, it's top of mind. So I have a lot of optimism that the continued forward push of AI and LLMs and making that more viable and more accessible is gonna drive better change.
I'm a huge AI skeptic, so for me, it's not AI. I'm not excited at all. Happy to talk about it later. I think data ownership is very exciting to me. That people can own their own data and do whatever they want with it and monetize, right? So I think one of the biggest challenges in financial services is that we'll focus on things that we can control, and that's help you save, maybe help you pay certain things, maybe give you some credit. But really, what everyone wants in our industry is help people make more money, and it's an impossible task. How do we make you richer? And there are companies, and I'm still watching very carefully what they do, companies that help you make money, right? Side hustle by selling your data. And this is a dangerous, very gray area where, you can get in trouble as a consumer. But if I own it and someone says, answer these questions for my survey, why go through some third-party research company when I can reach a consumer directly now through certain platforms and pay that consumer for their time to answer a survey? Now, consumer made $20, right? And you can spend all day answering surveys and make a few $100s, which is great, I think, for the consumer. And so I'm pretty excited about that. I think there needs to be regulation around it. Obviously, regulators are already thinking about data privacy extensively. And I think there also needs to be space for consumers to be allowed to monetize their own information and data. And I can tell you I think this is going to create a nice bridge in terms of mobility when it comes to socioeconomics.
All right. Lots to digest. This should have been a longer panel. It's cool. I think you'll be in the audience and there will be a reception to follow up if you have questions. So thank you for sharing your sparks today. And I'm going to turn it over to the next panel on alternative in mortgage underwriting.
Do you want
And then should we just,
Hey, everyone, we're going to get started with the final panel of the day. So please take your seats. So the purpose of this panel, which is the final panel of the day, is to look at how alternative data can improve mortgage underwriting. We have a distinguished panel, each of whom has been directly involved in some aspect of the process. I'm going to start with Wenzhen Lin, an economist at the HUD Office of Policy Development and Research. Then we're going to hear from Sirijana Giri, who's the product owner and senior director of loan products in Freddie Mac Single Family Acquisitions Division. She's responsible for single family credit and capacity offerings. That doesn't really roll off the tongue, you know. We're going to hear from Jonathan Gerwitz, who's the credit lead at Plaid. And finally, Brent Chandler, who's the CEO of Form Free. We're going to actually start with Wenzhen Li, who's going to discuss HUD's new study on the impact of incorporating rental payments into mortgage underwriting and qualifying more borrowers on FHA loans. So thank you. So Wenzhen.
Hello, everyone. So I'm going to present the early observations on the FHA positive rental history program. Okay. So let's begin with discuss the positive rental history in total. Total scorecard is used to evaluate FHA's loan application. So for positive rental history, it's applied to borrowers who continue to make on-time payment for at least $300 per month for previous 12 months. And FHA incorporate the positive rental history into total decision by lowering the acceptance threshold for those borrowers with positive rental history. To qualify, there are several criteria need to meet. So first, the loan must be a purchase loan. It cannot be a refinance mortgage. So and at least one borrower is a first-time home buyers, and the minimum decision scores is 620 or greater. At least one borrower has a positive rental history. So since October 2022, positive rental history has been included as element of FHA's total scorecard. And HUD has required lender to report positive rental history after March 2023. We observed that by the end of the August, 6,060 endorsements were accepted through total due to positive rental history. And for the reference, Fannie Mae and the Freddie Mac also have similar programs. So then we move to talk about the positive rental history, acceptance trends, and the patterns. And we can look at the left-hand side of this plot shows the number of endorsement with and without positive rental history. The axis in the x-axis, the X there represents the standard acceptance threshold, and incorporate this positive rental history into the total lowers this threshold to X minus beta. So the orange area in this range represents those borrowers who accepted due to positive rental history. Otherwise, they need to go to manual underwriting. So the figures on the right shows the share of endorsement accepted through positive rental history. We can see the share started very low in the beginning until March 2023, when the HUD required lender to report a positive rental history. The share started increasing and reached 0.8 at the end of August. So then we want to see the positive rental history borrowers' characteristic and how they are different from others. So this table here shows the summary statistic. The first column here represents those who were accepted due to positive rental history. Second column is those who just above the standard threshold, those with the lower scores. And the third column is all purchase loans. So look at FICO score here, we can see that those who accepted due to positive rental history has the similar scores compared to the lower score group who just above the standard threshold. And this table also suggests that the positive rental history borrower tends to have a lower assets and income compared to other group. I'm very surprised to find out that for the race distributions, positive rental history borrower tends to have a much higher percentage of black. It's about 6% higher compared to all purchase loans and 2% higher compared to those who just above the standard threshold. And same for the females, we can see that we also have a much higher share of females here. So it's about 4% higher compared to all purchase loans and 2% higher for those just above the standard threshold. Then we want to see how those positive rental history loans performs. Then we look at our right-hand side. This plot shows the average 90 days delinquency rate by positive rental history categories. So the green dot here, you can see that represent those people who accept due to positive rental history. So we can see that those people tends to have a much lower delinquency rate compared to those who just above it. So by the limited data we have, we can see including positive rental history into the total scorecard, it expands the credit assets without introducing the risk. So then we want to move to study like the use of the program. This shows the distribution of FHA's applicants. So this data here represents all purchase loans and first-time home buyers. So we begin with 1 million loans here. So we can see that only 3% of those are reported positive rental history and 97 does not. So this suggests that so this program is not widely used. And for those who are no positive rental history, we can see we observe that 8,774 borrowers, what we call the potential positive rental history beneficiaries. Those group are, so they could get a benefit from the program if they get reported. So they could be accepted if the program are more widely used. So, okay, so then we're going to see how the lenders are performed, like a difference in positive rental history program use. So this chart shows the distribution of top 32 lenders. So by positive rental history use rate. So here we can see that 28% of the lenders reported a positive rental history, only less than 0.5% applicants. So in the first histogram there. And the last histogram, we can see that there's one lenders report 16% applicants with positive rental history. So this large variance in positive rental history use suggests that there are some lenders are not fully used the program. So if you want to know more about the positive rental history in total, Jeffrey and I wrote this paper published in the on the website. And also thank you for Adam Hofberg to help me with the slides a lot. Thank you.
Thank you very much. That was great. And I had actually one very quick question. And on the slide that you showed, the percent with positive rental history overall, it was fairly low. But lenders are yet you require lenders to report. I assume that lenders basically say, will you make bank statements available? And if the borrower doesn't answer the question, then they're not, then they're sort of off the hook. Is that a correct interpretation?
I think so, because I think a lot of lenders may not think this program will benefit the borrowers, or they may not familiar with this program. So they will choose no positive by default. Yes.
Okay, thank you very much. Srijana, Freddie and Fannie are both looking at borrower qualifications now and asking if the borrower isn't accepted but has 12 months of on-time rental payments could be qualified. So basically you reach out to the lender, who then reaches out to the borrower, who permissions the data, and if 12 months of online payments are detected, the mortgage is granted, which is a cumbersome process, and the pull-through rate isn't as high as one would ideally like. I know you're directly involved in the initiative to incorporate bank cash flow data directly into the underwriting process at the outset. Could you talk a little bit about that?
Yeah, I think,
and actually, we're at slide. Okay. There you go.
First of all, thank you, Lori and Urban Institute, for having me here. I'm super excited to be here to talk about, some of the great innovative things that, Freddie Mac has embarked on. And I will tell you that this has been a journey. It's taken a while for us to get here, but I think we're taking all of the step in the right direction. So I wanted to just quickly orient everybody to kind of talk through a little bit of that journey. While Freddie Mac has been in forefront of leveraging innovation to make, home ownership more accessible, efficient and affordable. One of our flagship product that we have is Asset and Income Modeler, also known as AIM. So where we really started with this journey back in 2017, 2018 was looking as ways to make the origination process more efficient, right? So how can we kind of look at the way mortgage has always been originated with paper, documents, and using data to underwrite and create efficiency in that process. So what we did was we tried to look at all of the requirements in our guide and work with partners like Form Free and others to look at how can we use that data to create a more efficient process where we know that data is more predictive, we're reducing risk for the sellers, and then bringing the cost to originate down. And then eventually, the industry began evolving a little bit and exploring new ways to leverage alternate data to kind of transform into kind of converting more what we call a cautions to an accept. So one of the good examples that I can talk about is obviously using the asset account data in order to mining that data in order to look at borrowers' profile. So the first time in 2020, we announced a product where we're using the asset data to come up with the income assessment, and so folks don't have to provide your paper documents like pay stubs and W-2, and then using that same data to understand borrowers' cash flow. And if they were not qualified, or they were a thin credit, or they did not have credit score, how can we use that cash flow assessment in converting and providing homeownership for that borrower? And along with that, we also use the same data for the first-time home buyer, similar to what FHFA and Fannie has done as well. If
he had $300 in rent payment, how can you look at that borrower's profile? They've been paying rent for 12 months, and we know that this borrower's ability to pay, how can you make sure that they can afford that loan and they have access to credit? And going back to the model and the assessment, Lori, what we've done is, again, it's been an iterative process. So what we've really done is, really trained our model to kind of understand, hey, the borrowers that are on the margin and where we see either they're renters or they have good cash flow, we can message back to the sellers in our LPA, which is the underwriting automated system, to say, hey, this loan is right in the margin. If you go order an asset report, or this is a renter and has been paying rent on time, provide that information to us, and we can evaluate and provide our assessment on those loans. And we're only doing that for the population that probably can truly qualify, because we don't want to kind of fire on everybody and they go order these reports, which obviously costs money for the sellers and borrowers. So, where do we really create that efficiency? And again, getting more data, in kind of training our models, and we've been iteratively, fortunately been able to create a lot of enhancements to qualify. And one thing I'll leave here is this is part of our Freddie Mac equitable housing plan as well, both cash flow and rent payments. So this is really forefront for us. This is really important for Freddie Mac, and we've put in a lot of efforts here. And we publish our performance report every year. We've done for the last 2 years, and there should be one coming out for 2024 that shows like how many loans where we either fired this opportunity message to say, hey, this could be a person that could be a homeowner, go get this data and we can perform an assessment. And we also show how many loans we've funded. So it's kind of been an evolving iterative process, but I do feel like, we as GSEs, both Fannie and Freddie, are taking, right steps in the right direction.
Thank you. That was a great overview. Bank data is inherently kind of messy and sloppy, and but it's sort of hard to incorporate it into underwriting directly, which I know you guys have made great strides to do. What are some of the difficulties? And Brent or Jonathan or Wenzin, if you'd like to weigh in as well, please. But why don't you start, Jonathan?
Yeah, I can start. I mean, there's been a good amount of adoption. At least I've been with Freddie Mac for 10 years and been part of developing some of these products luckily from early on. So we've seen a good uptake of the rent payment data in the credit report, which again, as other panels mentioned, there's a lot of work to be done there. 3 million out of 77 million, right? But we've seen good strides of adoption in the asset data, where we can evaluate borrowers' cash flow and rent payments. So that's kind of been a good uptick, at least for Freddie Mac. We see 1 out of every 4 loans have some sort of a digital verification, which we know is going to decrease cost to originate, not just convert, cautions to an accept or provide that home ownership, but also reduce cost to originate and create efficiency and reduce risk for sellers, as well as for the GSE. So while all of those things have been great, a couple things I think that have been challenges in terms of adoption is awareness. I think we still got to do a good job of educating the borrowers, the sellers on the benefits of these digital tools, and how that not just kind of helps efficiency and risk reduction for them, or how it helps the homeowners. That's why all those improvements in Loan Product Advisor, where we're firing this message to say, hey, you can really do this, and we're providing a lot of real-time reporting as well. But I think there should again be a lot of push to go down this path of going digital versus docs, and really understanding that there is a conversion that can be done for the borrower. The other piece I would talk about is from a tech, there's some integration challenges as well, right? So now you have to think about we as GSE, we integrate with a lot of LOS providers, POS providers, and custom integration with lenders and service providers like FormFree and Plaid. So I think, just making sure that those integrations are seamless, right? Reducing cost in that area is critical as well, because a lot of that takes time and investment. And then just one other big thing I would mention is reluctance to change the process at the lender shop, right? So if you're a LO or underwriter, you're always used to like, collecting pay stub and W-2 while you order these reports. Again, that's going to create friction in the process. So how do you make sure that we train the staff at the, at all of these shops to help the borrowers, go down the digital path? So, and lastly would be just overall reducing cost in the space.
Yeah, that was incredibly comprehensive. But I'll just share a couple things. We see two key challenges in implementing open banking and cash flow underwriting solutions. One is really implementing the user experience. There's a consumer permissioning kind of connect your bank type user journey. And then the second is on the back end for the lender and for the folks they work with, how do I make use of that data? So we do a number of different things. One is we have guides that support with best practices. The second piece is we've developed no-code tooling. So lenders are able to text or email out an experience that is hosted by Plaid. And then we create a dashboard that has visualization tools for the data so that loan officers and folks can directly review it. I think the last piece is ensuring that we have a comprehensive set of insights and analytics that sit on top of the cash flow data and make it possible or kind of reduce the lift of folks actually having to go directly into the transaction data and build their own custom attributes.
Can I actually ask a follow-up question on that last point? So if I pay the rent for 3 months and then my husband pays it for another month, then I pay for 2 and then he pays for 1, do you have a way to tie those accounts together so you know that the rent is getting paid, or is that sort of something that's future, or is that already here?
In general, that would be future state. It depends on how do you connect, who is the account owner on each and how do you connect that identity? Currently it's really focused on a single institution. So if you've got multiple accounts at the same institution, we're able to support. But I think there's bank transaction data is still messy, and there are still going to be challenges in that situation.
I can maybe do a follow-up quick, Lori. At least our assessment in our model, we are able to combine multiple accounts. So it doesn't matter if my husband was paying last 6 months and I decided to pay this 6 months, we're able to combine all of those accounts to mine that data to come up with a decision.
And that is precisely where a company like FormFree comes in. This journey has been 17 years, if you can believe it. 17 years ago, an idea that everybody borrows and everybody has an ability to pay some amount. And I could quantify it mathematically, empirically using aggregated data. Why? I had spent 8 years prior working in data aggregation and saw it used in so many use cases. So I said, surely it could be used in getting a loan. And who was getting a loan? It was me. I had my data. I wanted to share it digitally instead of faxing and printing and all this stuff. And that's literally the genesis, the founding of FormFree. And what later became the creation of a pilot that Fannie and Freddie adopted for day one certainty. And so the source data became the corpus of what could be utilized for understanding risk. That's what it became. You see, each and every one of us, we are the risk element in every loan that we do. It's me. It's me the lender has to understand. It's me the secondary, the investor has to understand. I carry the risk. The willful disregard of lenders to assess a borrower's ability to repay. That was the Federal Crisis Inquiry Commission postmortem of the 2008 crisis. And I would argue that it wasn't a willful disregard necessarily, but the tools weren't there, the data wasn't accessible. And so this evolutionary change has happened. And what we focus on at FormFree is really understanding that data. 48,000 financial institutions producing billions and billions and billions of transaction data types that we apply natural language processing and artificial intelligence to understand. Once we can understand what these data transactions are, what they mean, we can then begin to do pattern recognition and other things and assign, just to Lori's question, that there are 2 people involved in this rent payment. This rent payment belongs to this household, and we can see that before we even present it to the lender. And that's the essence, is really getting to the consumer,
enabling them, empowering them with their own data. It's your data. 1033 said open banking. You know, that was a big win, right?
For sure.
Plaid worked on that for many, many years, and a lot of people pushed that. It's your data. You own it. The banks are fiduciaries for you. And that means you can move it and use it how you see fit. Wouldn't it be great if you could use it to say, this is how much I can borrow, this is my ability to pay, and I'm qualified before you even pick up the phone or find a lender that's ready to work with you? And that's in essence what we work towards, is it's intelligent use of the data to put it to practical applications.
Thanks. So Srijana, what role do you see for the cash flow underwriting in the future?
There are
what
a couple, yeah, there are a couple of things that I see. The big one I would mention is expanding access to credit, right? That's the big one. I mean, cash flow data obviously provides more holistic view of borrowers' financial health, and it enables lenders to understand, which borrowers are qualified, who may not meet the normal traditional criteria, like renters or gig workers and individual with non-traditional income sources. The other area is enhancing risk assessment. Right. So I think cash flow would be a better predictor of risk than a DTI. So that is something, as long as we can scale this data and have this data holistically. I think credit scores are great, but it's a snapshot in time. And now at least Freddie Mac LP evaluation and model can take in trended data, which has borrowers' history of not just what happened that month when they pulled the credit, but how did the borrower pay, like in the past 12 months. Again, I talked about the predictive power and better default prediction. I think the other big thing is just driving efficiency in underwriting, streamlining data collection, objective decision making, and cost reduction.
Thank you.
Yes, I think I agree with you. So I think it will definitely improve the model performance. So by adding more insight about borrowers, like payment behaviors, about their financial behaviors. So I think it will turn out to be more accurate and maybe more credit assets model.
Thank you. And we're going to go to we're going to go to Jonathan now. Plaid is a fintech that allows lenders to gain a holistic view of an applicant with just a few clicks. It allows lenders to easily access a potential borrower's bank statements, as well as income and asset verification. Could you talk a little bit about what you're doing and how you work?
Yeah, happy to. So I'm Jonathan Gerwitz. Happy to be here. Thank you to the Urban Institute. Thank you to all the panelists. I've learned a ton from everyone here. So I lead our go-to-market efforts for our credit business unit at Plaid. So at Plaid, we're focused on powering the open banking technology that supports applications and services for banks, fintechs, many of the Fortune 500, some of the panelists here. We specifically in the credit and lending ecosystem, we support over 1,000 lenders, including many players in the mortgage industry. We also support prop tech, residential leasing businesses for use cases across the loan life cycle. So everything from income and asset verification to cash flow underwriting to payments and identity verification. So really excited to be here overall. I'm going to talk about cash flow underwriting adoption, really powered by open banking and its implications for the mortgage industry. But I'm going to start with kind of some basics on cash flow underwriting. I know we've dug deep in a number of panels, but when I talk about cash flow data, I'm talking about the bank transaction data, the balance data that flows through the bank statement. Now, this data has always been important in lending, assessing someone's ability to pay. But what I would say is, despite its importance, and honestly, it's tremendously broad coverage, the majority of Americans have bank accounts. it's largely taken a back seat relative to other sources of credit data like traditional bureau data. I would argue that the reason there is some of the things that have been mentioned on this panel. Historically, cash flow data has actually been really challenging to collect and analyze. It's required printing out paper bank statements and delivering it to a loan officer, or in a digital context, even downloading and uploading PDFs and having someone manually review it is challenging. So that's where open banking really comes into play. Open banking allows consumers to permission their cash flow data directly to lenders in a seamless, secure, and digital format. And we've seen a ton of momentum around cash flow underwriting and open banking in a number of different areas. So it was mentioned earlier by Brent, but the rulemaking from the CFPB finalizing consumer data rights is a really exciting one. It provides a ton of benefits for consumers and really unlocks cash flow underwriting use cases. In our research, we also see that both consumers and lenders alike are ready for cash flow underwriting. North of 8 in 10 lenders are open to using new data sources and really focused on cash flow. North of 7 in 10 consumers are open to sharing their bank transaction data as part of a loan application process. The last piece I'd say in terms of just momentum we're seeing around this is in the research that we've seen, as well as our work with customers, we've consistently seen an ability to expand access to responsible credit. And so that's a little bit of context on cash flow underwriting and open banking. I want to talk about a little bit kind of the phases we see around lender adoption of cash flow underwriting. Because we've got this wide lens across the credit ecosystem. We work with a number of different lenders of different product types, as well as across the credit spectrum, everything from thin file and subprime to super prime. So the key phases here we see are initially starting with verification use cases. So this is typically automating processes that were previously manual, and mortgage, things like asset verification. The second bucket is really around second look. Whereas the verification process was really focused on ensuring that stated information on the application is accurate, second look actually starts working in the data into core decisioning, specifically for folks that might otherwise be declined, give them the ability to share additional information to get approved. The GSE programs here are great examples of second look incorporating rental payments. The final phase here is first look, and this is really what we're so excited about. The ability to kind of permission and share that data directly at the start of the application alongside all of the traditional data sources like bureau data. Now, candidly, there are fewer lenders doing this today, but we see a tremendous opportunity, particularly in mortgage. So think about an applicant experience where, directly from the start of the process in a really efficient way, a lender is able to capture verified income, verified assets, verified employment, check eligibility for these GSE programs, do additional cash flow underwriting to expand access to credit responsibly. We see just a ton of opportunity overall. And so, I'd say that's the overall evolution we've seen. I think we're encouraged. I think we've seen a really strong wave in kind of the initial verification bucket in the mortgage industry. I think we're seeing a second wave here spurred by things like 1033. And then, I think kind of looking ahead, some of the initial testing that folks have done around second look and first look, are going to create a really strong and positive roadmap here.
Well, thank you. That was great. So you mentioned the open banking rulemaking being finalized by the CFPB. So how do you think how monumental a change do you think it actually is?
Yeah. So, I think if you look at the mortgage industry, and comparing it to the phases that I've outlined here, there over the past decade or so, there was that initial adoption wave on things like asset verification. I think that that has also expanded to income verification as well. I think with the kind of finalized rulemaking, what we'll see is yet another wave. I think as kind of the bank connectivity and the experience for consumers becomes more efficient and more resilient and more stable, I think we'll see more and more lenders adopt it and adopt it in a deeper way. And I think there's going to be kind of a really positive cycle that's established that as lenders continue to adopt it, I think you'll see all of the infrastructure providers that participate in that process also continue to innovate around it. And so that's the software providers, that's the GSEs, that's the bureaus. And so as all of these parties are moving together, I think we'll get to a world much more quickly, kind of the first look world, which is adds so much value for consumers in terms of creating more efficient process, expanding access to responsible credit, and delivering more competitive offers.
Does anyone else want to add anything to that? That was great. That was a very helpful answer. Thank you.
On open banking, to me, it's freedom. I mean, now, the banks are going to be required to allow this data to flow, and the consumers are going to be able to kind of pick up and leave and do different things. But they'll always have a true, historical composite of their own personal information. And to your point, how does that translate into all the downstream applications and the use of the data? Man, it's unending. So I think it's a watershed moment. And the banks participating, you're going to see higher quality of data, which means secondary investors can now depend on that data even more. And the instantaneous kind of interplay with your own data, by virtue of open banking becoming law, the idea that you have to scrape or that you have to go through all these mechanisms to get the data, that's one of the biggest challenges. And is data missing? Is it partial? A lot of that's been obviously taken care of over the years. Plaid's phenomenal at doing that. But I see to your point, it's a wave. It's a new beginning.
Thank you. In the interest of time, we're going to move to Brent. Form Free has developed a score that provides a more holistic view of the borrower than credit score alone. That is, by combining credit scores with residual income from bank statements. Form Free has come up with a measure that more accurately predicts a borrower's ability and willingness to pay. And when I first saw this, I thought it was really cool. So Brent is going to talk about it. Thank you very much.
Here we go. Yes, Lori, thank you so much. I'm Brent Chandler, founder and CEO of Form Free. Been around a minute, and Lori and I have done some work in the past related to the rent programs, and I'm happy to report the first initiative we worked on, 2015, was really identifying, the consistency or how often a borrower would provide rent, and that 12 consecutive rent payments with a certain amount of rent per month and a FICO score of 620 became the 2021 rent eligibility Fannie Mae program and AIM program. So that was thanks to her and that 3-year program we worked on. But clearly, Urban Institute is looking at data for greater purposes of homeownership and reaching the unserved or demographics of folks that have been left out of a conversation for too long. It's just too long. And rent is such a strong, it's just a strong element of a person's ability to pay and capacity to pay. And when we look at rent payments, we think about maybe 120 million consumers, 40 million households, making some level of consistent payments that equal to or greater than, on average, a mortgage payment. That's a pretty big deal. Like, these people are paying mortgages, they're just not owning the house or the unit. So it would stand to reason that these payments have some value towards their propensity and ability and capacity to pay. So that's what we dove into. And so when we think about the consumer, we think about the first touch with the consumer. And the first touch with the consumer is to provide access to that trusted bank account. And the purpose of doing that is to get a loan. Once we have that connection, that relationship right up front, we're able to pull this report. And this report really delves into the analysis and the analytics and the AI and the bifurcation of AI to deterministic accounting, which is residual income. And so what I want to point out on this report is essentially the Ricky score. Residual income knowledge index of a 130 simply means that this person is meeting and exceeding their ends meet needs month to month and has for over 12 months. In this case, they're trending higher as well. So Dr. Covington and I, over 15 years ago, started working on the residual income knowledge index, and it's a determination of delinquency. It corresponds to a FICO, and with the help of lenders and GSEs in over the last decade, we have a corpus of data that proves unequivocally equal or better risk delinquency than FICO. I know that's a strong statement. I'm ready, bring it. But yeah, it's proven. And it's really about the delinquency, and residual income is such a strong characteristic that we can see it in the bank balances. We also look at the credit. We're not saying throw credit out. It's a really important vector of data, but added to a corpus of 5 other component analytics, now you have a rich financial DNA holistic view of me and what I can afford. It's a borrowing power. It's based on that account balances stuff. We can also see a DTI. Where it really becomes powerful is when we look at a heat map, and this is the correspondence level. This is a delinquency ranking, but as we can see, not all FICOs are created equal. We can see in the far bottom right, we can see a 7%, a 120 to 150 for a 400 to 649 FICO is equivalent or even superior to a 760 FICO with a low Ricky, 80 to 99. And so what this begins to tell us is that, you know, people who do not have FICO, who may have consistent rent payments, we've identified 13 million super prime home ready renters right now by HMDA data that don't have FICO, can't get a house, can't get a loan, but they could with a different score of measurement. And that's what this is proving. Thank you.
Thank you. That's very cool. So can you share examples of lender success with the Ricky cash flow analytics?
Yeah, so we've been very blessed and fortunate to work with over 3,500 lenders in the community over the last decade, and one comes to mind that has really jumped out. I'm going to promote Guild. Guild and David Batney, phenomenal champion of access to the underserved, unserved, reaching into programs to drive homeownership access. And they adopted our prior product called Account Check, which was really a verification tool, asset verification, income verification, employment verification, all bundled up in that asset, that harvest. And they've used it on every single loan. Applying Ricky to that over the last 10 years, we've been able to feed some of that data into a variance with Freddie Mac. And we've been working together for several years on this proof point and identifying how we can dovetail these consumers with a Ricky index, sans FICO. And we have proven that on thousands of loans, working with David Batney and promoting this into GSEs, Congress, Capitol Hill, et cetera. We're really hoping for a day where that consumer can be looked at and have some assessment of risk beyond just a 3-digit score, which we believe is to some degree, whether intentional or unintentional, discriminatory. It's keeping people out of home ownership.
So one thing that was particularly striking in this whole panel is, sort of the degree of collaboration between organizations like Plaid and Form Free and the GSEs and FHA. So basically, what do you see going forward? That is, how can collaboration with regulators and GSEs support wider adoption of cash flow analytics? So why don't we start with Brent, and then Jonathan, and then Srijana, and then Wenzin on this question.
Yeah, I would say.
I was just, that's the one thing that sort of really came out, is sort of how you guys are all holding hands in this process.
Well, I think from my perspective, the common denominator is the human, right? We all want to help. Like I've heard it from everyone on this panel, including yourself. You know, what are we doing? What are we actually trying to do? We're trying to serve the underserved, the unserved, the people that have been left out of the conversation. Rent is a very strong data point, extremely strong. And everybody on this panel understands that and has come to the same conclusion. So to the degree that we are actually working together, I think it brings so much hope. We are moving this data lake to a new place where we can say, yeah, this data from this consumer, coming from the consumer into a GSE, a Freddie, provided by a Plaid, and then into programs of HUD that immediately can turn that 3% into a 30%. That's what I see.
Jonathan, anything to add to that?
Yeah, I think mortgage is a very great example of space where no single party can do it alone, right? In every loan, there's so many different components. There's so many institutions and entities that touch that experience. So, we built out for asset verification, to improve on kind of the manual process, create automated asset verification. We did everything on our end, but it was really critical that, we partner closely with the GSEs, both Fannie and Freddie, to ensure that, when a lender pulls that it's able to be fully and efficiently processed through the platform. So that's been an incredibly productive partnership that has expanded from not just assets, but also to income. And I see, examples of that across the board. Another example is, point of sale systems, loan origination systems. How can you really seamlessly embed the consumer permissioning experience and make it more ubiquitous, right? That unlocks kind of the various analytics and the programs we talked about on the stage. So we see a ton of opportunity. In fact, like that, from my perspective, that's the only way some of this stuff will scale at a greater pace.
And then from a Freddie Mac perspective, obviously, our mission is so important to us, right? Making home ownership available for all. So looking at the data and innovation and really figuring out how to scale. So as I talked about in my presentation, I think we've taken steps in the right direction and, we see the adoption growing, but looking at ways to figure out how do we scale that. The ecosystem is very complex, right? We couldn't do a lot of this without the data from Plaids and the Form Frees of the world. So that's been really helpful, Lori, to your point about working with the ecosystem, right? Data, the LOS provider, the technology providers, and making sure that we can feed our engine to be able to create what we create. And then now I think looking at ways we can incentivize the sellers on this journey, either be it education or even the cost of the report, thinking about how to reduce cost in this entire ecosystem. So thinking about different thoughtful ways to scale this. And the second aspect of this is, the risk reduction aspect is very important for Freddie as well. And again, looking at the data to figure out how do we improve our models in order to, create better models to predict default.
I think we all have the same goals, like to come up with more accurate and open, allow the more people to access the credit. So I'm so glad that we're working on the same topic together and end up with the same result. This rental payment is very important. Yes, and that's yes. I think sharing this information to lenders will be very helpful to encourage them to participate more into the program.
So there are actually two questions that are sort of looking forward questions from the audience that I wondered if any of you have any thoughts on. The first is, what are the implications of the cash flow for advances in the use of cash flow data for regulatory issues like the qualified mortgage rule? Because it just wasn't contemplated when that rule was put out. Any thoughts on that? Just wasn't one of the ways that you sort of qualify through the ability to repay, and all of a sudden you're sort of using it. I don't know. I thought it was a very interesting question, even if no one has answers.
I recall, so I'm thinking about the Dodd-Frank ATR ruling, and I'm remembering DTI or residual income and it was on a monthly basis. And so the idea that it wasn't readily accessible in 2014 would stand to reason that how are you going to capture residual income on a monthly basis without a digital access and to be able to sift through 15 pages of bank statements? So I think that to me, maybe I would answer that maybe it did contemplate, but it didn't. It left a door open, and now I think we're kind of entering that.
Then the second sort of looking ahead question is that particularly for LMI borrowers, consumer incomes are sometimes very poorly matched with a single mortgage payment, which is a large portion of gross income, and that can create stress and potentially missed mortgage payments. There are no options for partial payments, for more frequent payments, or anything that could more closely match borrowers' income flows. What, if anything, is being done to look at how to reform the monthly servicing model to more closely align payments with income and therefore reduce potential delinquencies for borrowers who have been underwritten to the outer limits of the GSE's underwriting guidelines? My guess is that no one's really doing any work in terms of the servicing side. We're just trying to get the underwriting side right now. But I thought that was a very interesting question, and I just wanted to bring it up if anyone has any thoughts.
Yeah, I mean, I can just maybe give a little bit. We've been starting to explore the data and the servicing side. I think to your point, the focus has been more in the origination space, and even the journey that I talked about, right? Starting from just manual process to paper to data, and now kind of thinking through the alternate sources in the credit evaluation. But we're starting to kind of think through some of the implication and mining the data internally on the servicing side. So probably more to come on that.
Yeah, and I would just share quickly on the servicing side, a couple of things that we think about. Number one is when you look at income streams, being able to identify the likely payment dates is something we do. We see adoption more in kind of the unsecured consumer credit space to best protect consumers from NSF fees by having kind of that mismatch, Laura, you talked about. The other thing I would share is we are focused on kind of post-origination use cases and kind of supporting in terms of a consumer is able to permission that data, not just at origination, but on the servicing side. And if they do so, kind of getting support when they're unable to miss a payment. So thinking about things like proactive forbearance. Again, we see more of it on the unsecured side, but we see a ton of opportunity there.
Well, thank you very much. I think our time is up. I'd like to thank my absolutely wonderful panel. This has been really, really very interesting. I've learned a lot. I'd like to thank the earlier panelists. We've had 3 great panels. This last one on how alternative data can improve mortgage underwriting. We've had the first panel on the impact of rental data on credit scores, the second panel on innovations and helping consumers build credit. This has just been a tremendous day. Thank you all. We're going to end with a reception outside. Thank you, Bilt. We really appreciate your being with us today. Thank you all very much.